If you're looking to get funded and want to save big on prop firms, check out our website, A1Trading.com. On our website, we have a massive catalog of different sponsors and prop firms that are offering really competitive prices to our live stream viewers. On the screen right now, you see a QR code. If you scan that, it'll take you to this page that I'm looking at to scan all the different offers. You can also filter by one-step and two-step accounts. You can also look at futures, Forex and CFD prop firms, and even prop firms offering stocks. You can also select your preferred prop firm challenge size and check out our menu at the top for tons of different prop firm perks and giveaways. For example, every Monday we do a weekly prop firm giveaway that you can sign up and add your name into the hat for free. Additionally, we have prop firm reviews for notable firms, and we even have a side-by-side comparison tool where you can compare two firms head-to-head. Save big and find the right prop firm for you over on our website, www.a1trading.com. Thanks to our various sponsors who make this show possible. Now back to the content.
What's up, my dudes? It's Wednesday. How's everyone doing? Hope everyone's well. Welcome to the stream. We have the big day, FOMC, one of the most anticipated days in the markets for us traders. So before the questions come in, we always get asked, or at least I always get asked when I start streams, where's Nick? You're not Nick. Or Nick turned British. There's always the British joke. So Nick will be coming on later. The way that these FOMC streams work, or the later news release type streams work, is someone else will start, then you'll have other guests, then Nick, and I think Chris will normally come on as well to actually cover the news with you. So do not worry, Nick will be on later. But yeah, you've got me for now. Ray Beast, hello, good to see you. One Opportunity, hello. Jeremy, hello, good to see you all. Hope you're well. So we've got two options today. We do have an interesting PDF. I took a quick scan. I haven't read it yet, but there is a PDF here by MUFG that's covering the Fed and some FOMC stuff today. If you guys want to have a look through that, or we can just keep it normal. We can just take a look at the markets. We can have a look at some trade ideas. I'll let you choose. Completely your decision. I'm only here for half an hour today. I normally do 1 hour, but it's half an hour today. So we are on a bit of a time crunch today. So let me know. What are we talking about here? Hey guys, crazy day in preparation. Be careful. We have escalation all over the place. Yes, it is. It's going to be a tricky day potentially. Although you shouldn't really be trading FOMC unless you have a good idea of what you're doing and what everything means. Hi James, what's up? Let's do some trading rap songs with my voice. I stutter far too much for rap. Unfortunately, you know, I'd probably make a lot more money if I was a rapper, but yeah, maybe in another life. Do I still backtest? No. Shows the FOMC. Okay. Yeah, we'll have a look at the PDF then. I'll try and keep it short. I won't do this for the whole half an hour. I'm not going to read everything, but we can have a quick scan together, and then we'll see what else we've got lined up for the rest of the day. So this is a PDF by MUFG Bank, direct from them today. Oh, sorry, not today, yesterday on the 28th. So it's new, it's fresh. So don't worry, the information is up to date. So here we have the probabilities that MUFG are expecting. So we do have a hawkish hold is their base case with a 55% probability. I'm not going to read all of this. So if you do want to read it, screenshot it, pause the stream, whatever. Again, we're going to have a scan through rather than read every word because that would take too long. Then we have a neutral hold here with a 40% probability. Hawkish hike is only 4%. So anyone that is expecting hikes today, you might be a little bit disappointed. Of course, we do see a bit more of a probability of a hike if we look at the FedWatch tool, which we can take a look at after this, an uber hawkish hike, which would be 50 basis points plus. That's a less than 1% probability. I don't think anyone is really going to be expecting that anyway. If you are, you might know something I don't. Hike expectations to keep getting pushed forward until the facts change. So with the last SEP showing 9 out of 18 FOMC members expecting a hike in 2026 and the war-keeping inflation fears elevated, hiking expectations will linger. So they say, we believe that the market implied rate hike probabilities increasing to 35 to 40% for the upcoming July FOMC meeting is more of a function of the markets hedging for the risk of a potential hike rather than the actual prediction of a hike transpiring. We expect this pattern to continue until the facts change. So doesn't really mean too much, to be honest, for us. If we are trading expectations, it doesn't matter if it's more of a hedging idea that these institutions have, or whether they are or whether they are actually expecting hikes, the market's going to move in the same way. But it's something to keep in mind. So basically what we would take away from this is that MUFG specifically, and again, I want to clarify, this isn't my thoughts or opinions. I don't want to take credit for this, or I don't want anyone to pin this on me. It's not mine. I'm just showing you. So basically the MUFG is saying that they don't expect any rate hikes until we have solidified data and a real reason for the Fed to hike, which I think is understandable. You know, at the moment we do have a lot of things up in the air with oil, inflation, and Iran. So definitely something to keep in mind. It doesn't seem like that one's overly interesting. Hold on, I'm just gonna, again, I've not read through this, so I'm gonna have a scan with you. So they're going into the macro here. Growth, the economic growth party has barely started, so why hike? Real GDP expected to grow less than 2% in Q2, or the second quarter. A less than stellar quarter despite continued support from the One Big Beautiful Bill. Effects of the OBBA, the One Big Beautiful Bill, likely contributed at least 0.6% points to Q2 real GDP growth, but the economy is still projected to grow only 1.6%, or roughly 1.6% at this rate. The economy is growing at or below potential with slightly negative output gap. Far from overheating economy that needs hikes. So they're basically, again, scanning it, not doing a deep dive into this by any means. I don't have time to do that today. But they are saying essentially growth isn't warranting the Fed to hike rates at this time. The labor market, jump in retirements could explain the rise in job openings. So as we know, we did see, we saw NFP underperform by about 50% on the previous release, and we saw ADP not do too great. Job openings was a bit more optimistic. So what they're talking about here, job openings have been rising since the start of the year, coinciding with a sudden and off-trend rise in retirements, perhaps just a replacement cycle. So it's not necessarily a case of new jobs are opening. It's not a case of we got all these new businesses or already existing businesses that now have all these vacancies on top of what they already had. It's more a case of, oh, they've actually had a lot of people leaving due to retirements and they're replacing the people that are leaving. So it's not really as it looks on the surface, if that makes sense. So that's kind of what they're saying there. Inflation basket is not signaling an urgency to hike either. With a degree of volatility, core inflation is generally softer in 2026 for both goods and services, and trending that way for months. January and May were standout months for non-housing services components exhibited strong price growth, but super core inflation has generally been weaker, with many components exhibiting deflation in 2026. Overall, there are fewer signs of broad-based inflation pressures in the CPI. Okay, let's just see if there's anything else we really need to have a look at here. Otherwise, we can we'll move on, have a look at some data, and see what we could actually expect. So, market is doing the hawk's job of tightening credit and rates for them. Alternative forms of measuring how tight and expensive it is. I don't think there's really that much here that I feel like we need to discuss at this point, or going forwards, really. Risk and market change on the day. Okay, this is just disclaimers. Okay, cool. We've had a quick look. So that should give you a bit of an insight. But again, that's only one bank. So whatever is said in there doesn't mean it's 100% guaranteed. So it is what it is. It's like reading any other type of analysis. So it was just a perspective I did want to show you because I thought it was quite interesting when I had a first glance this morning. Bond, James Bond. Yeah, you can call me James Bond. I'll take that name. Hi, James. What's up? Let's do some. Oh, wait, hold on. That's a message I read earlier. Shows this FOMC paper. Yeah, we just had a look at that. Oil is up nearly 8%. Is it? Is oil up that much today? Yeah, I mean, we did have headlines come out yesterday, didn't we? I was in bed and I saw a Financial Times here. This is really dark. I'm not sure if you guys can see it. US says intercepted attempted surprise Iranian missile attack, ending pause on direct strikes. So yeah, it's not been necessarily fantastic. It's something that we've been talking about on my segments anyway. I'm not sure about the other people, but it's a very precarious situation. You know, we've had so many escalations and de-escalations. It's an absolute nightmare to try and trade at the minute, especially on a short-term time frame. So you know, if you're a day trader or intraday, yeah, not being fun for you guys, I would imagine. Oil long, very nice, Jeremy. If you are oil long, good stuff. Better not to trade at all today. Yes, I would agree with that. Sluggy, hello, good to see you. Holding some position. Holding some position. Very nice, Ray Beast. I'm glad you're holding some position. Looking at repo markets, I think the odds are higher than expected. Currently, especially with an expected September shutdown, they need they need cash, but so they need a crash. Yeah, I've not actually looked into the repo in a while. I should probably do that. I might have to do it this weekend. RBA really missed on inflation. They did indeed, yeah. Heard that on Bloomberg Radio. Okay, cool. Right, we're caught up. So let's have a quick look at what's going on here. Let's take a look at the CME FedWatch tool. Seems like the most fitting thing to do as we are on FOMC day when it loads. There we go. So as we looked at earlier, the MUFG report was saying that there's they've got a 55% probability of a hawkish hold. That's kind of that is their base case. In terms of hikes, it was less than 4% that they've got expected. That's not based off CME FedWatch tool. They've got their own proprietary ways of doing that, like a lot of other institutions do. So here, what we do see on the CME FedWatch tool, however, is a 66.3% probability of a hold and only 33.7% probability of a hike. Excuse me. I don't think we're going to see a hike. I'm very much expectant of a hawkish hold. I think when I say hawkish hold, I don't mean by any means that the Fed is going to say that, oh, we're going to hold in this meeting, but next meeting we're going to hike. I don't think it's not going to be that cut and dry. But I would expect them to take a bit more of a cautious approach towards inflation. And we did also see the labor market weaken again with the NFP data as well. So I would expect a slight hawkish lean, but again, no major really shock, if that makes sense. However, when we start looking at the expectations from September into 2027, we do see that the expectations of hikes do get increased quite drastically here. So September is 19.4% probability of a hold, and then over half, or a massive majority, actually, 80% roughly percent probability of a hike, whether it's 25 or 50 basis points. And that pattern's repeated throughout 2027. So we're not going to go and have a look at every single one. But yeah, interesting stuff. So what we could expect is if we actually get more of a dovish lean, we could see a bit of a repricing within the dollar. And actually, that would lead to quite significant downside, I would expect. However, if we do get the more sort of hawkish tone hawkish to neutral tone, I think where the markets are going to kind of continue with what they've been doing with the dollar drift to the upside. Overall, of course, the initial reaction might be a bit more bullish than just a drift. Right, let me just catch up on the chat here. US dollar yen spiking higher. Yeah, the dollar is doing quite well today. We can take a look at that in a second. I'm enjoying the oil rally. I'm sure there's a lot of money being made in oil at the moment. As long as you're not getting on the wrong side of these swings, I'm sure you're doing quite well. How do you manage your emotions when it comes to trading? Just don't trade massive size. When you trade a size that is pretty negligible, it doesn't impact you at all. So let's say you've got, it's the same kind of as shopping. So for example, obviously, when you spend money, it's like a stop loss essentially. So, if you've got, let's say, $50,000 in your bank account, buying, something for $10 or $50 even, or maybe $100 doesn't really affect. You're not going to think twice about doing something like that. And it's the same thing as a stop loss. It's just the cost of business. And as long as your cost of business is manageable to whatever your budget is, then there's no need for emotions to come into play. I think the whole psychology thing, 90% of the time, does come down to the fact that people just oversize and they don't know what they're doing. I think it's actually a blend between the two of those things. Do the opposite of retail. That's a good tip. What are you say? Market will go up and down? I don't know what you're trying to ask me there, my friend. Why are people so neutral? What do you mean neutral? In what aspect? Looking to short the Australian dollar soon. Yeah, I think the Australian dollar could be a good short, actually, especially after the inflation data we got. I think, that would be a pretty good decision. We can take a look at some of these markets in a second. I know I keep saying that, but I'm just trying to catch up with the chat, and then we'll go ahead and have a look at the markets. I've never thought of an SL as shopping fee. Great analogy. Yeah, that's really all it is. It's the same thing. You could also think about it like running a cafe. I've used this analogy before with some of my students, that you cannot run any business, but I use the cafe example, without having these expenses, whether it's unexpected, or expected. So, you could have a staff member that's carrying a tray of coffees that just slips and drops all of them. You've lost the coffee, you've lost the glasses, or the cups, and then you've got to remake them. So you're always going to have these expenses, whether it's a bit larger than you expected or completely normal. So again, business is business. You look like Jadon Sancho. Who is that? I'm gonna have to Google that because that's piqued my interest. I need to see if that was an insult or not. Hold on. Okay, I'm gonna take that as a compliment. That's quite a good-looking guy. I don't swing that way, but I can appreciate looks when it's there. So thank you. I think full moon equals market crash. Interesting. Okay. Right. Anyway, let's go into the markets, because we're going to end up just sitting here and blabbing for half an hour. I've got used to the 1 hour segments where I have time to just yap. So what are we looking at today? So I'm still in gold longs. As I've been saying, do not copy these positions. These are longer term investments, buying discount, DCA sort of an investment approach, not a swing trade for someone to copy. The position sizes are extremely small, 0.01 lots, every $100 increment. So this is more of a bet on a long-term appreciation in gold, not a short-term swing. But on gold, I do remain bearish, actually, which is why I've got orders down here, because I do expect gold to continue lower towards 3,500 in the sort of medium term. I mean, it does obviously come down to whatever the Federal Reserve says tonight. That could completely change. But as far as I think base case is bearish, gold will remain bearish in the sort of near to medium term, or short to medium term. I am still short euro dollar, which is a nice little hedge for my gold long, just to protect a little bit of the downside or the drawdown. Again, I am quite bullish on the dollar at the moment, so I'm quite happy to go short euro dollar. So what we have on the daily is a moving average cross, just very simple change of trend here. Broken below the daily level of support, we came back up, retested into the 50% fib retracement, and it looks like we're going to continue lower after we've had this little bit of a rejection. So I really like euro dollar. Left side also looks quite appealing here. We don't really have that much support. I think really we are very likely to head back down towards 1.1. I think, based on my my opinions. Seasonality on euro dollar actually is very supportive as well. Not quite yet. I think it's sort of mid-August. Seasonality on euro dollar does get really bearish basically into the start of December. So this position may not work out, but I still really like the idea of being short euro dollar. Again, it does come down to what the Fed says. I'm going to say that quite a lot this stream, so I'm just going to underline and pin that. Everything I say here is very dependent on what happens later today. Although this is still kind of base case. As I said, I do still expect the neutral to hawkish lean. Pound yen. So this one has been a little bit of a kick in the teeth, to be honest with you. So some of you will remember we were looking at, I was looking at pound yen or CAD yen. And the reason is because both are or were, they both were on the edge trend. Pound yen actually was the top reading, and CAD yen I think had 2 or 3 points slightly lower than pound yen. So the decision ultimately came down to picking pound yen. Now, that was clearly the wrong decision because pound yen has just been moving sideways, whereas CAD yen has now increased in score or overtaken pound yen, and the market's moving higher. So unfortunately, I've got, the market's just laughing at me in this situation. So there's not much I can do there. But hey-ho, the fun of trading, am I right? Look how the markets act on full moons. It's a statistical fact, is it? Interesting. Never looked into sort of the, is it this, not astronomy, astrology side of it, but I know there are people that trade moon cycles and things. To be honest, I've always laughed at that, but if there is a real edge in it, then fair enough. Who am I to say it doesn't work? GPJPY seems like it likes to come down some more and then have a clear hold or dollar cost average. Yeah, I think pound yen is bullish. I've got no qualms or problems with the idea that pound yen is bullish. I'm very firm on that idea. The only real issue I would say is the intervention possibility. So if we do get an intervention, as we can see historically, we come down to the 100 daily moving average. That would stop out this position, but it would allow me to get back in long at a slightly better price or a cheaper price. So it's fine. That's kind of the downside at the moment with trading the yen, because dollar yen is very elevated. So I think the risk of interventions is just increasing and increasing day by day. On the other side, there is the idea that the Bank of Japan might hike rates, not necessarily on Friday, but in the meetings following. I'm not really too bothered about that, to be honest. I think that, yes, the BOJ might hike, but then we've also got other central banks that are very likely to hike as well. Like the Bank of England is expected to also hike. So the idea that, okay, the BOJ is going to hike, we need to buy the yen, I don't think that's a good enough reason because the yield gap will still remain. Possibly widen even further, actually, depending on exactly how things go. How does short euro dollar give you the beta against gold? Not, it's not a, when I said a hedge, that maybe wasn't the professional term. When I said hedge, I more just meant long and short dollar. So whilst if I'm betting on dollar strength with euro dollar, and that is my bias really, as I said, the gold trade is more of a long-term approach for the next 6, 12, however long it takes. It's a long-term idea. So that's the thing though, because I do see gold coming lower, that means that yes, my positions will be activated, but I would still be in drawdown. That's just factual. So the way to offset some of that drawdown is actually by buying the dollar at the same time, which is what I'm doing with euro dollar. So it just offsets a little bit of that dollar risk. Okay. Reading fundamentals was a hassle for me, and now astrological. Yeah. I mean, the thing is, now I'm thinking about it, it's one of those things where I think it's very easy to laugh at until maybe you do look at it. Again, I've not looked at it, so I don't want to speak too much on it, but it's like technical traders. There are very good moments where, technical traders will take a position that just doesn't make sense fundamentally, but it works out. And it's the same with kind of Bollinger Bands. We've actually been speaking about Bollinger Bands quite a lot on this channel recently, or in my segments, I should say. But it's one of those things where, if someone says, oh, they trade Bollinger Bands, you kind of just feel like, well, what are you doing? But then if you kind of look at them on a higher time frame, lower time frames, not so much because it doesn't work right there, but especially on higher time frames, it's like, obviously, euro dollar was very bullish in this period. If you just sold the top, and people will probably laugh at you for doing that, you would have made money. Same thing here. Same thing here. Now, I'm not saying that you should. Absolutely not. Bollinger Bands, I don't think, is a good strategy on its own. But it's one of those things in the markets where it doesn't seem like it could work or should work, but it quite often does, actually. Anyway, moving on. What are we saying here? Hold on, let me see what I've missed here. Short Aussie US dollar RBA rates already high and inflation falling. We did say we were going to look at the Aussie dollar. So I think actually it's a good thing I didn't take this position. Let me add my indicators back. So yeah, Aussie US dollar, I think, is actually a fantastic trade idea. At the moment, I would say it's probably one of the best ones based on exactly what you said, Modi, about the cooler inflation. RBA's already hiked 3 times and now on pause. And we do have the Fed tonight. Obviously, again, depending on what they say, that could change. But at the moment, I would say this is a pretty solid idea. So in this case, what I would do is just wait for wherever the next low is, wait for a pullback into the fib, let the daily moving averages change trends. So actually, hold on. How can I? There we go. Sorry. There we go. So wait for these moving averages, if I can talk, crossover, sort of establish this bearish trend like we did over here. At the moment, they're a little bit clustered and a bit ugly. So I'd like to see them fan out again, really define a bearish trend. Then, yeah, take that fib from the high to wherever the low will be. Wait for a pullback into the fib, retest previous structure on the left, and then I would be looking to go short here. I think that's a really simple, clean, basic idea. But yeah, I would say it's a very solid one. Gold is going downtrend. I mean, gold isn't going in downtrend. Gold is in a downtrend. It has been for months at this point. Yeah, gold's not in a good position for buyers. Hi, James. I entered pound yen and CAD yen, both EF bullish, had the fib rejections. Was this logical to enter on those together? Christoph, sorry. Yes, absolutely. That's exactly what I do. Yeah. So I know, Christoph, you're in my Discord, so you'll see the way I trade. Pound yen is exactly what you just said. Bullish on the edge finder, pull back into the fib, previous structure on the left, bullish trend. That's it. Easy peasy. I have 20 short contracts on gold and 2 on silver. As soon as flash crash happens, I'm DCA into bullish contract. Very nice. Really nice. Everyone make sure to buy physical gold and silver when the crash happens. Yeah, it'll be a good time to load up. Okay, so we are starting to run out of time. We've got about 5 minutes left. Let's just take a quick look at the Edge Finder again and see if there was anything. So the Nikkei was an interest of mine earlier, and unfortunately, it just happens all the time. I just missed the entry. I just wasn't paying attention at this point. I mean, this was very quick anyway. It was only a wick, but it did come back into this 50% retracement. This is exactly what I was talking about, throughout earlier this week, retesting the previous level of support. And now it looks like it's continuing lower in this bearish trend on the H4. So the setup on the Nikkei is fantastic. The real downside I've got, though, with the Nikkei is just this daily trend. I'm a little bit concerned it might just reach the 200 moving average on the daily and show some sort of rejection. We also have the daily RSI that's a little bit oversold. So it looks good on the H4. The daily, though, just has a few red flags that I'm not overly comfortable with. I'd still take it, but I think I'd have to be quite aggressive with the trailing stop on that one. I suppose we could end off with the dollar. So today with FOMC, it could be the catalyst for the dollar to finally break 102. It could not be. Again, if the Fed comes out dovish, we could see a complete repricing and the dollar continues lower, actually back into the range that we were in for the past year. So that could be one situation. But what I would really expect is a higher dollar. Again, not even just based on the Fed, but if we just look at it from a technical stance as well, we've been holding this fib retracement for quite some time, failed to break lower below these previous highs. We had the break and retest pattern. We are coming back up. And then, if we look at the higher time frame, I think, again, there might be the idea really that we're actually about to start this new bullish cycle on the dollar where we could continue higher towards 105, maybe 110 at the previous high. I don't want to really forecast that. I think it's a little bit far away at the moment. But yeah, I'd say if we do get the sort of hawkish tilt by the Fed today, I would say 105 on the dollar is absolutely doable. So yeah, that's currently my stance. I think my opinions on the markets right now are very linear. There isn't really much really to consider. I think really the biggest sort of spanner in the works is obviously the oil situation with Iran, Strait of Hormuz and things. But at the moment, I'm taking that very much as kind of just fade the idea or fade the headlines. I'm not actually fading the headlines, but my opinion, again, my thought process is, we've just had de-escalations. It's probably just going to re-escalate again, because that is historically what has proven to have worked. Until that changes and we do actually see a peace deal get signed and it completely ends, then that idea will just continue to work, I think. Again, I'm not actually trading that way, but that's just my thought process. So I'm not really even accounting for it that much. It's more just noise to me at this point. It's annoying noise, absolutely, but it is just noise. The reason why markets sell on full moons due to lack of sleep, stress levels are up. Studies show 3 to 5% in profits compared to new moon cycles. Okay, interesting. Gold is up for 3 years. Kevin Walsh will finish gold in the next 4 years. What do you mean by finish gold? That's a bold statement. I'd be interested to know what you mean exactly by that. Gold and silver historically also sell initially during big wars. Then money flows into gold and silver. Okay, cool. So, so the Nikkei, as I was saying, I would still like to go short. We do have the bearish reading on the Edge Finder, so I think it's all aligned, really. Again, it's just that daily time frame that I think is a little bit of a problem, or could be a problem. Gold, New Zealand US dollar, pound dollar. So we are still seeing this sort of dollar bearish idea on the Edge Finder. And this is where it gets a bit tricky, because while the fundamentals do remain very weak for the US, so if we look at the heat map, we can see here, the US only has a score of 40%. We got weaker labor data. We had cooler inflation. PMIs missed. So normally, this would be a sign to sell the dollar. But with the fact that, yes, we're expecting a hawkish Fed, but also the fact that we're getting these headlines of re-escalations, oil still isn't flowing, the expectation by the market really is that inflation is just going to get higher or heat up. So it's a little bit of, it's one of those situations where the data is saying one thing, but the context is kind of saying a different thing, or the other factors are saying another thing. I'm not sure the right wording for that, but hopefully you understand what I mean. So yeah, take the dollar with a grain of salt. I would really say that the most important thing is whatever comes out tonight by the Fed. Obviously, I think we should all understand that. Anyway, ladies and gentlemen, it is my time to end my segment. We do have, let me just double check. We do have Tiger coming to take over the show. So guys, have a fantastic rest of your day. Please stay safe with the news coming out today. Do not get margin called. That would be absolutely terrible. Guys, I'll see you all tomorrow. Thank you for being here, and don't go anywhere. We have Tiger coming to take over the show.
Don't go anywhere, traders. The show will be right back with our next show host. But before we get back to the show, I wanted to mention today's live stream sponsor, Ola Prime. Ola Prime is one of the fastest growing prop firms that I've seen in the space, and they offer a super wide range of different account types. Whether you trade Forex or futures, whether you're a swing trader or you're a day trader, they have multiple different account types, and they have some of the most competitive pricing that I've seen in the industry. And check out this publication from Deloitte, who did an audit during a select period of time on Ola Prime and its payout legitimacy. One of the big things that Ola Prime is well known for is their very fast payouts. They have this posted up all over their website as one of their main reasons that traders like them. From what we've seen, they also have a very strong reputation overall within the trading space, and they are a proud sponsor of our everyday trading stream here. And for a limited time, if you use our promo code that you can see on the screen right now, A1 Trading, you can get 20% off any of their accounts. And using our discount code lowers the barrier to entry, meaning that your challenge costs you less and gets you that much closer to potentially getting a payout someday. Of course, to throw my 2 cents in there, I'm a big fan of not trying to get funded until you feel you are actually ready to do so. So if you feel you have the skills, if you feel that your trading is up to par, and you do your due diligence on Ola Prime to see if it's right for you, then make sure use our promo code to get that extra discount at checkout, and we'll be dropping the link to them down below in the live stream chat. You can also find it in the description, and we'll have a QR code on the screen right now that you can scan if that's easier for you as well. So thank you to Ola Prime for sponsoring today's live stream. Now back to the next show.
What's going on, everybody? Happy hump day, happy Wednesday, happy Fed day. It's coming up here shortly. I hope you're all doing well out there. So as always, guys, if you would let me know any specific tickers you guys are looking at today. Dollar, gold, silver, pound dollar. I know Andrea's hiding in the chat somewhere. I know she's going to ask me about it. We'll definitely check out the majors. We got some time to do that. Just as a reminder, of course, you do have the code there on the screen. A1 Live for your discount for Ola Prime. So definitely check that out if you guys are looking for your next prop firm or your first one. It's a really good one to start with. Really simple. Very transparent rules, the whole shebang, ladies and gents. So definitely give them a look. You got the QR code on there as well, if you prefer to do that. So, where we stand today? Well, Fed Day once again, and just in taking a look at the projections over here. Currently, we still have a third of a chance, or 33% chance that they might hike today. However, the overwhelming majority is still that we will keep rates the same today. I think this got up to over 70% yesterday at one point. So we have dropped down to the 66% percentile as it stands right now. Of course, it's a very dynamic list. I think this thing updates every 15 minutes or 30 minutes or something like that. But that's where we currently sit. So it's obviously going to be interesting to see what Kevin Warsh has to say in round 2 of his presser after his first one that he had. And I've got a question for you guys. I've got an over-under because he's all about his task forces. I'm sure he'll definitely get some questions from the press on that as well. But the over-under is, how many times will he say the word task force? The over-under is set at 2.5. So just put in the chat, more or less. What are you guys' thoughts? Kind of interested to see. But anyway, that's coming up. Chris and Nick will be on a little bit later, and they'll be able to dig a little deeper into that for you right about the time the statement comes out. So, where are we at? Let me go look at the chat over here real quick. NAS sell off infinitely. Yep, we shall see. We shall see more. Okay, everybody thinks it's way more. Says it's just B. Yeah, that's kind of what I thought. I thought I might have put that number a little too low, but interesting stuff. So, okay, top setups. Still got all the yen pairs up there as far as yen sells, meaning buy the other currency. We got the Canada yen, Kiwi yen, pound yen, euro yen, Aussie yen, all the yens. You get a yen. Everybody gets a yen pair. So let's go take a look at a few of those till I see some tickers come in as you guys want to see them. So, and just starting off first with gold and silver. I know that's everybody's favorite. As far as the Dixie itself, that's where I always like to start, just to see where my moving averages are, so on and so forth. Still got that overhead supply. We're still a ways away from it, though. That's the 4-hour overhead. And I did even put in a call wall clear up here at the upper end of that supply zone. So again, that's the daily. The red is the 4-hour. So that's really the confluence point I'm personally just taking a look at. And then a little closer to home underneath, I am looking at a couple potential bounce points where currency pairs could see a turnaround if the dollar does drop. From Kevin Warsh's speech today, down around the 101 level is the first one I'm looking at, as well as 100.77 area. That is where I see a couple potential support areas, a couple demand areas there for potential bounces. And on that note, just kind of flipping things around for gold and silver. Gold has continued its little bit of descent. Now, you guys have heard me blabber about this for the last week or so. I'm still just not interested in gold unless we start breaking some of these major structures. And I'm specifically looking at it on the daily time frame because, again, I just think that it's going to have to really prove itself for me to get interested in the +4 score that we have over here on the Edge Finder, the top setups. So that remains the same. However, it would not surprise me at all if we do get that descent to continue. I do see a little bit of I do believe 30-minute zone of demand down here. Let me just double check the time frame I have right here at the bottom. And remember, this was that this is that higher low over here on the daily. So we've talked about that a handful of times. The gold is giving us at least the higher low versus silver that still currently is not. And of course, it's descending on its own. So that is the one thing I do like about gold over silver is we at least have that higher low. And that higher low did give us a pretty good amount of volume, guys. A lot of volume spread analysis activity that took place with this red candle. You guys hear me talk about yellow candles all the time, but it's not too often. The red candles are harder to come by. Okay. And those are going to be obviously to me stronger than the yellow candles. Remember the green candles, just to recap this, guys, green candles are average transactions relative to the last X amount of candles. The blue candles are below average. Okay. I don't mess with any zones at all that include a below average volume candle. Rarely on the green, unless I'm getting kind of an ascent. Okay. As long as volume is growing along with price going up, and just as an example, then, and I think we talked about an example of that a couple weeks ago. Okay. I don't do that very often either, but every now and then, if I see at least volume starting to pick up, then I might perhaps consider a zone at that point. But it's all about the yellow candles. But when we get these red candles on the leg out that we did have right here, that's a pretty good sign. So I would not be shocked at all to see some type of at least a strong reaction from that. If we do continue to drop down to that level, we also do have a little bit of a put wall there as well. Okay. So there's a little bit of a put wall there. As always, you get price dropping in. That's some bearish bets in the options market. Give them just a little bit of excitement. Have price go down a little bit, but then that's where I think the potential reversal could come. Now, this is in context of the moving averages going down and still the fact that we don't yet have a higher high. So I don't know how much of a chance I personally would want to take at buying that dinky little 30-minute zone, but there's no denying that red candle looks quite appealing. I got to admit to you. So I may even perhaps just for the hell of it take a little bit of a stab, a very small risk at that, just to see if there might kind of put in a feeler position down there. But I understand that we still don't have a higher high, and I understand that my major moving averages are still pointing lower. So it's going to be interesting to see. Okay. I will go ahead and watch that area. There just may be a good line of items kind of, hitting all at once there. And then also, let's do this also. I wanted to go put just a little trend line up from the bottom to the bottom there. So let's get that like that. Okay. So just a little bit of a trend line there that could also potentially just add one more little point of a potential odds enhancer for a bounce. So I'm going to keep an eye on that, guys. It is definitely breaking some of my rules, but it's not very often. Once again, just to put a bow on this, it's a lot more rare to find the red candles on a leg out. They just are farther and fewer between versus the yellow candles. So that's ultra high volume. That's a lot of institutional type transactions taking place. So I like that. We're going to keep an eye on that. Okay. As always, that's not financial advice, but I will keep an eye on that zone just for my own personal thinking on that. Let's see what you guys got over here. Excuse me. Yeah, why is everybody so bearish on gold and silver? Price action, structure, right? Now it's dropped quite a bit. Could it be an exhaustive down move at this point? Who knows? But I like to stick to price action at the end of the day. We can have all kinds of really good fundamentals and sentiment and negativity towards the dollar that should benefit the gold in retrospect. But until the price action turns around, to me, it just remains bearish. Not bearish enough for me to short it because, again, the fundamentals are turning around. And the dollar the dollar data is going down, still down at that 40% level. So I'm not bearish to the point I want to sell it or short it. Absolutely not. I think that'd be stupid for me personally with the way I trade. But again, when you look at the moving averages, the series of lows and highs, again, that's the one bright spot that gold does have. So I wouldn't even say I'm bearish necessarily on gold. I would just say I'm more neutral. And that higher low does have a pretty good, that's a lot of the reason right there. And then that ultra high volume bar I just showed you guys on that 30-minute. But silver is easier to say negative or bearish. It's starting to base out too. Okay, it's gotten really lazy after this big descent that we had. But again, where's the structures of higher highs, higher lows? Or in this case, lower highs, lower lows. It's still pointing down along with the moving averages. Alligator's mouth pointing to the downside. So, price action, it's just mainly the price action at this point because everything else seems like a pretty good spot to buy. It just does. But I personally am just really, really big on that, on the series of highs and lows. So hope that helps. We've all got our own reasons. That just so happens to be mine. Expecting too much from gold after nearly 3x move. I'm not expecting anything. I'm just waiting for the series of highs and lows. That's ultimately what wakes me up on this stuff. Let's see. Gold flat. Didn't stream it before. Can remain flat for years. Yeah, exactly, Yon. Yeah, Nick has definitely touched on that. Gold and silver, just like we saw at the summer to fall and winter of last year, was just. Remember, we joked about it. It went past the moon and started going to Saturn at one point through early January, and then it just kind of got stagnant. Yeah, gold and silver can definitely go sideways for a long time. Absolutely. Roop Chowdhury. Hey, Tiger, I'm short on Swiss yen from Monday highs. Can you look? Yeah, let's go take a look at Swiss yen for you. Go have a look. Let's go have a look. And I'm normally the one that ends the show, so I got my alarm set so that I don't overshoot my runway today. So we're good. That will definitely go off and let me know it's time for Alan. Alan will be up right after me, guys. Swiss yen. Let's go over here. Okay, so the moving averages are going down. That is a plus. We got low, high, lower high, lower low, lower high, lower low, lower high, higher low, and then it just kind of stalled out and went sideways. Now, recently, and you said what day was that you took that? Monday's highs. Oh, okay. So what is today? Today's Wednesday. So you got short up in this area right over here. All right. Bounced off a 200 EMA on the 4-hour chart. Yeah, I mean, look, I can't blame you for it. It looks like it's kind of rolling around. We did have that, obviously, that outlier drop, but then it came right back in and the pattern kind of continued, kind of this oval shape move downwards. I see what you're talking about. When it comes to the way I trade, yeah, there's a lot of wicks here, a lot of rejection wicks. I just didn't really see a supply. unless I would have went a little higher personally. And then again, this is just what I see. I mean, you may very well have a really good strategy, but what I would have seen is just the fact that we do have a supply zone a little higher, which we missed. We had this this contraction. Yeah. And then we had a breakdown. It did break this structure right here, but I don't know that that was that strong of a break for me personally, to where I would have had any interest. Now, fundamentals and sentiment aside, I'm strictly looking at this on a technical level at the moment. In fact, what is Swiss yen giving us? I know it's neutral, but I'm just curious if it's more on the bullish. Oh, Swiss yen. Oh, you're going, okay. So you're +3. So it's neutral, but you're kind of going against the very, very slight bullish tilt that it does have. Unless we look at, the technicals. Yeah, because see, look at the eco score over here. Remember, the yen is quite strong right now. Now it's getting smashed, obviously, by as far as dollar yen goes, just as an example. We've been hearing about the yen being in the dumps, a 40-year low or whatever the case is. But the data does favor the yen right now over the Swiss. Sentiment as well. So you're basically looking at this on a technical. Look, to me, it looks like you're doing on specifically a technical approach, I guess I could say. Only thing I would say is with this little price action down here, okay, there's really not that much volume right there. I don't know that I'd be that worried about this little lip down here. And then there's really an efficient price structure through here as well. So you might be good for a swing. I mean, at the end of the day, do what you want, but wouldn't shock me to see this drop to the 199s, 199 3/4, or 198 3/4 rather. But yeah, just be aware of that. I mean, you are starting to come into a little bit of support, a little bit of consolidation here, a little bit of consolidation here, plus the major swing low. So when you step back and look at this on a higher time frame like the daily, you always want to be aware of swing lows like this, swing lows like this, even though I think that one might be a little more of a minor one because it didn't really break this structure at all. So just be aware of those areas. That's all I'm saying. Okay. 199.30 area, be aware of that area, and clearly be aware of the 199.72 area. Maybe you sell half or buy to cover half of it. Okay. Or if you think it's going to continue down, then you just do your thing. But yeah, fundamentally and sentiment wise, I don't really like it. I gotta be honest with you. Not to mention it is a +3, so it only needs really 1 or 2 points of strength, and this thing could flip around on you. So just be careful with that. Speaking of the currency strength, I do want to go take a quick look at that and get an updated look at this. Oops, wrong chart. Wrong chart as well. Let's see, where am I at? Oh, I need to get down here to macro scanners. Come on. Macro scanners. Sorry about that. Hit the wrong button. This thing's getting so robust, guys. Talking about the Edge Finder, it takes a second sometimes to find things, which is awesome. And as always, for the Edge Finder, keep in mind any upgrades, if you guys have a copy, any upgrades are completely free to you guys. So if you have not gotten your copy of this thing yet, definitely consider it. I 2, 3, 4 hours a day to where you're not having to go and pull all this data together from 42, 142, whatever it is. Dollar 40%. The Swiss, if I can get. Sorry guys, did I lose you? Give me a second. I just got to refresh my chart here. Got a little funky on me. I think I might have one too many things open. Okay, so Swiss, yeah, the Swiss is also 66%. So the Swiss and the yen is right there together. So that's the other thing. They're both fairly decently strong from a fundamental perspective. So anyway, yeah, that was Swiss yen for you. Dollar yen, says David. We got euro yen. Yeah, let me try to bust through these for you all real quick. Looks like euro yen was first. Hey, I just bought euro yen right now. Can you tell me if it's good and why not? And why not? I want to learn. Well, the first step is just keep watching our shows. All of us guys on here have a little bit different ways of tweaking our strategies. No two traders are necessarily the same. We all have the same basic concept or the basic idea. It's just how we get there, right? The trip from A to B sometimes goes in little squigglies. So just keep watching us. Figure out which one you like, which one talks about a specific topic or strategy that appeals to you or that you understand, and just kind of build your own. But let's go look at the chat, the ticker for you. And that was euro yen. Okay, so a couple things on this. So number one, the EMAs are looking good. We did break a structure. Okay, so definitely the trend is up. Now, the thing is, or the challenge is, we did just recently bounce into this daily supply. So let me just go a one chart look for you so you can see this a little easier. Okay, so we're talking about this overhead resistance here. Daily basing candle, very strong gap down with a, what color of a VSA candle? Yellow. That's the daily. We go to the 4 hour and look at that same area. Now, we're just touching the daily, but a little bit higher up. And this is especially what you'll want to be aware of, is the fact that we've got a little bit of a confluence point here as well. So that's basically starts just under the midway point of the daily box I drew up, the daily rectangle. So, for me, there's no way I would be considering buying right now, just because of the fact it did already touch the daily. And also it basically got one big rejection off of it already that broke a minor structure. If we drop down to a 1 hour to a 30-minute, something like that. But all I'm saying is be aware, because a little higher up at that 187 area, we'll just call it the 187 psych level, you might have a new set of eyeballs getting into the picture considering to shorten that thing. So as always, do what you want. All I'm doing here is just giving you potential landmines just to consider for whatever your strategy is. I think the best move was already made back here on this zone back here that already kind of got touched. But now, again, it's bounced into that daily. So I don't really have a play whatsoever on euro yen because it has kind of pushed pretty high on the curve, in my opinion, if we're just looking at swing lows and swing highs. So just be careful with that. That's all I say. You asked about dollar yen. Let's see. We got pound yen as well. We got dollar yen, but ahead of that, though, right? Yeah, David asked about dollar yen. So let's go take a quick peek at that for you. So on dollar yen, and you asked 165, I think it was. Hey, if we get to 165, we're going to be into this white line represents the winter of 1985. Anything above, we start getting into the early summer. So I do believe this is November of 85. If we cross that, then we bounce into June of 1985. So we're going further back into the past. So I was personally kind of interested in that area, which is literally right at the 164.5 level, like dead on. I don't know, man. I just don't know if the Bank of Japan wants to allow it. But we've been saying that for how long now? A month and a half, 2 months? Every time they intervene in their currency, it gets retraced up only to go even higher on the dollar yen. So when is enough for them? I just don't know. I just don't know when enough is enough for them. So I don't project like that. I'm not Nostradamus. All I know is I don't know. That's only a difference of about 6 months, November to June or whatever that equates out to. I don't know the immediate math, but I don't know. That's in other words, that's my next personal checkpoint is 164.5. 165 is another 50 pips higher. What I did draw up on dollar yen, even though we don't have a signal for it, I don't think at the moment. Yeah, dollar yen is a +3. Again, dollar data has been getting rougher relative to the yen, so that's why we're getting a little bit of a negative score on that. But other than that, the sentiment, the technical scores, obviously looking good. We can see the technicals from a mile away. I'm actually watching this daily zone that just kind of got created in the last couple of days or a few days. This was our leg out candle from, I guess it would have been Thursday. And then the Friday candle, which based and stayed pretty high up relative to where we closed our base. So looking at that on the daily, because that does kind of create a gap. This would be our gap right here. Okay. High point or proximal line, if you will, of the daily demand. And then the bottom of that second candle after we ignore the leg out. So pretty good strength, I think, right there. What was my volume? That's one thing I did not look at. Okay. Yeah. Light volume. So very, very light volume. But then when you go down to the 4 hour and you look inside of that daily box, we do have a 4 hour confluence right here. So me personally, I'm actually watching that 163.09 area. And to the 163 is the distal line of that same zone. So that's kind of a point of interest I'm looking at. If we get one more piece of bullishness, if we get something, I don't know, we get anything hawkish out of Kevin Warsh or any details out of that speech that he's going to give us here later. I don't know if we get any, and clearly if we get a rate hike, because we do have a 33% chance, right? Then I'm going to be keeping my eyes on this zone right here. Now, tomorrow we have PCE coming out, so that could affect it. We had CPI, we had PPI come out a couple weeks ago that were cooler, which obviously drug the dollar down. And a lot of times that PCE, not always, okay, not always, but a lot of times that PCE tends to follow the CPI and the PPI. So that could present us with yet another bearish point on the heat map over here, that eco heat map. Because I think the last one was neutral, if I'm not mistaken. And why is my chart not loading? Come on. My chart's going a little slow today. I just got through with an interview with a guy in Ireland for a podcast that I host now. And I had a whole bunch of programs open. So maybe that slowed it down. But anyway, oh, come on. Well, yeah, it's neutral. I can see right here. So that's going to have a bearing. Now, if we get for whatever reason, if we get a spike on the PCE, well, that'll add a piece of strength to the dollar, which could help us go from +3 to +4 on the dollar yen. So if that's the case, then I definitely would be interested in this potential zone down here. So I actually need to put an alert right there because I definitely want to keep an eye on that. My voice is scratchy today, ladies and gents. Sorry about that if it is. When I get to talking and running a podcast, oftentimes I lose my voice. And this is the first time I've done it before my streams. So yeah, apologies on that. But anyway, yeah, that's going to be what I'm looking at personally is that 163 area, 163.10, 163 proper there for dollar yen. Okay, I got 4 minutes, and you did also ask, somebody asked about pound yen, I do believe. I saw that up there. So it is right there with all the yen pairs. Double check over here from the start. So everything looks good on the daily, higher highs, higher lows. I talked about this very high on the curve zone up here that I personally didn't have any interest in. We did get a little bit of an initial bounce from that. And it looked like it wanted to start curling around, but it just never did, and it started dropping. So for me, nothing's changed on pound yen. I still want to see price drop, base out, get a little manipulation in this area, and then bounce into these zones over here on the left. This is a daily and a 4-hour confluence. I really personally like that 215.52 area. However, for me, when I get this situation where my intermediary time frame is the zone, if it's just a little higher than the higher time frame, well, rather than buying here, I would prefer to wait. In fact, I need to move this. I would prefer to wait till it actually drops down to the second time frame. That way I'm actually getting the daily eyeballs on it as well, and not just relying on the top end of 4 hours. So I personally want to see it go deeper through the 4 hour and just again to where it actually touches the daily, and I get those two sets of eyeballs looking at that same possibility of a accumulation of their positions. So that's what I'm looking at on pound yen. Yeah, it's basically a repeat of what I've kind of been talking about with this particular one for the last several days. Just kind of recap that. Let's see here. Let me see here. Shouldn't touch yen pairs. Yeah. Dollar INRI. What is that? The Indian rupee? I'll be honest with you. I know nothing about the USD INR. I don't think I've ever even brought it up. I mean, hey, at the end of the day, a chart is a chart, right? Well, trend is up. We are getting close to some overhead supply. I mean, that's kind of the quick answer. I can see right now we do have a dollar. We do have a daily supply that we're bouncing into. So I can at least give you a couple levels on this thing. Yeah, this is probably a thinly traded instrument as well. The 4 hour, this looks hideous to me. I don't see anything in this area. The only thing I can tell you on that is we're pretty high on the curve clearly. If we just scroll out and we're bouncing into the daily supply, and that's clearly why we're getting a drop. Other than that, the only other thing I could say is there's a daily demand it's getting close to bouncing into, okay, which would be in this area for the 4 hour. But again, I don't like the way these candles form. And yeah, I don't like it. I would have to only look at this on a daily, perhaps even a weekly daily, for me to have an idea on this. If we go to a weekly, guys, we do have a weekly demand a little deeper down. So maybe we could go down here on the daily. And then, by the way, I would have to make that a different color, make that orange. And then from the daily over here on the left, I could maybe say, okay, there's my daily demand. So that's a weekly daily confluence. Where and again, this is just technicals. This isn't even looking at any of the fundamentals or anything. But if you're just looking for technical thoughts, daily demand here, but down here you have the benefit of a weekly daily confluence. So that's about the best I can do for you on a chart I've literally never even typed in my entire life. Hope that helps. Kiwi yen, and I know I'm about out of time. Kiwi yen. EMA's up. High on the curve, so it is a little pricey. I want to see personally on Kiwi yen a break and close above this major swing high. If we get this, and it can close anywhere in this area, the higher the better, then I've got to retrace down to looks like a smaller time frame demand than the time frame I've got right here. Oh, no wonder, that's a daily I'm still on. Okay. Yeah. So 4-hour demand. Okay, I'll end it on this because I know I'm out of time. That would be the area that I'm looking at on Kiwi dollar. But again, nothing happens unless first we break this structure up here. Okay, so I think I'm out of time, guys. Hope that helps. Hope you learned something. Again, we do have Alan coming up, Marco to follow, Chris to follow him, and then Nick to kind of end the show today. So Nick is taking my job. He's in the show today, ladies and gents. Hey, happy Fed Day. Stay safe out there. And yeah, have a good rest of the show. Talk to you guys tomorrow.
Today's video is sponsored by 8cap. And did you know you can actually get a free copy of Edge Finder with the help of 8cap? The way this works, basically, if you create an account under our referral link, which I'll have linked in the description down below this video, you can actually get a free copy because they purchase it on your behalf. Now, how this works is basically if you follow the link that you'll see on the screen right now, basically scroll down to where you can see all of the different offers that we have, where if you deposit a certain amount of money into a new 8cap account, they will effectively buy our products on your behalf so that they're free to you, you get them free, and you also start trading with 8cap. Please also make sure to do your own due diligence on 8cap to make sure that is a brokerage that meets your own risk criteria. All the information, like I said, can be found in the description down below about this specific sign-up offer. Thanks to 8cap for sponsoring today's content. Now back to the video.
Good morning, everyone. How you doing? Happy Fed Day. We have a lot of viewers here looking at some, let's see, we got oil requests. We have a gold view. We'll go ahead and cover all of that. Like the advertisement just said before I came on, 8cap is having a 20% welcome bonus. Make sure that they are the right brokerage for you, but they are a very good brokerage from my understanding. So go ahead and check them out if you are looking to switch your relationship. But hope everyone's doing well. Let's get a consensus here in the chat. Dovish or hawkish? If you are hawkish on this Fed day, do you think that the Federal Reserve Chairman Warsh is going to be hawkish? Type 1 into the chat. If you think he's going to be neutral to dovish, type 2. I'm looking to see what the consensus is. 1 hawkish, 2 dovish. Hey Kier, hey Joanne, hey Jeremy, hope you're doing well. Wow, let's go ahead and get started here. So oil, Tony says 1, he's going to be super hawkish. 3, crypto man, 3. I'm assuming that means you don't know. Well, I'm on that same boat with you, crypto man. 2. What's up, man? You're Aussie. We'll go ahead and cover that. Yeah, we're going to go top down here, preparing for the FOMC. 2, 1, we're getting some mixture in the chat. 3, don't know. I also don't know. Well, let's start off with this. Let's see what the market is telling us so far. CME Fed Watch for today. As of now, market is pricing in a 33% chance of a rate hike and a 66% chance that rates are going to stay the same. So I'm going to go with that. Looking at the yields here, let's go to 10-year yield is up 0.89%, and then the 2-year yield is up 1% today. So maybe that's the market telling us that we're maybe kind of hinting more hawkish. One thing I will say, oil is up today. So I know that was a big request here going into this live stream that I saw in the chat. You can see that oil was up 7.62%. That is a meaningful jump in the price of oil. We had a lot of progress yesterday, especially going into that close of the market. We saw oil dip I think it was like 3 or 4%, I would say. Yeah, 3.6% oil dropped towards the remaining couple hours of the session. And now we're seeing all of that walked back and some, largely due to some continued strike in the Middle East. So that's definitely not going to be good there. We did have this week, early in the week, we had the US and Iran kind of strike or halting their strikes. And then I think Iran fired a surprise attack yesterday or something like that. And now we have some retaliation back and forth. So oil is up today. I will say, though, my perspective on oil, my analysis is this. You did kind of hold this trend line here to the bearish side of things. We did have bears step in, take this lower. We also have this level of support here that was a really solid level during the escalation when the war was going on. So you had support here once, twice, 3 times. We did finally break into that level. We traded back above it here. So now this is going to be the real test, in my opinion. Is this going to be a situation where bears go ahead and take it lower from here, and this is just a pullback into the continuation? Because if you put a fib from here to here, right now price is at the 50% retracement level, which this could be support turned into resistance. That is scenario 1. Scenario 2 could be this is the trend changing, right? We had bearish price action here. Now we are seeing a pull higher, a pullback, and then a continuation higher. So we'll see if this level does hold. To me, this is a very important level. I don't know about you guys, but to me, this $85 mark is pretty telling. If you see price action continue higher from here and hold above this level, then this is most likely than not the market is just preparing and pricing in more escalations, higher prices, and that would actually lead to inflation. Versus if this level holds to the downside and we see bears continue it lower, maybe to that 200-day, then maybe the inflation fears can get scaled back just a little bit. So that's kind of what I'm watching for oil. I'm curious to see if there even is any guidance to what war says about the prices of oil and it, creating lower inflation prints. I'm curious to see what that happens. But yeah, that's what I'm looking at for right now. FX pairs that I'm on. I don't have any FX pairs that I'm on, but I am looking at this. So this is kind of what I did yesterday here with you guys. The only position I have on is this gold long, which is underwater here, down $1,000. But here's what I'm going to show you guys. So for FX pairs, let's go to euro dollar and let's put this back up here. So if you were to get a hawkish Fed today, anything hawkish, yield higher, the market, CME Fed Watch 2 kind of going more into the restrictive stance, then I would look for a Euro USD short. So this market here short, I would sell somewhere around here, not looking to get any precise level or anything. I just want to be in this general area. And then my stops will be above structure. The first target I will look for will be 1.12. And then beyond, I will just trail my stops like that. So that's first position if you get some kind of a hawkish stance. The second one would be USD CAD long. So with this one here, we are still within this level. It seems like buyers are kind of taking it over right now. If we were to see price stay above this level of resistance and this turns back into support, that would make me very happy. So if it goes from red to green, I would like to buy this continuation higher, maybe target these recent highs and then trail from there. So that's kind of what I'm looking for in the hawkish scenario. If you were to get something surprisingly dovish, which I'm going to say this, I don't think we're going to get much forward guidance this time around, but if you get something surprisingly dovish, maybe the market and yields start to, trade lower there, CME Fed Watch 2 kind of goes more into from hawkish, like 2 hikes to maybe 1 hike or neutral, then at that point, I would continue to hold my gold long, and then I would look to participate in pound dollar long. Pound dollar is kind of holding grounds here at that 61.8% retracement level. Again, it's been pretty quiet yesterday and today, as expected. Markets usually kind of quiet down right before a big news release like this, and then they continue to move after they get clarity. So pound dollar long side looks kind of good. So yeah, that's kind of what I'm looking for. Euro dollar short, in case you have some continued strong dollar. I'm also curious to see what happens with DXY at 102. Okay, so this is a level of resistance here that we have to be mindful of. It had capped in advance here in June 24th and then again July 1st. So this seems to be like a pretty strong level, I would say. So I'm curious to see what happens here. If you were to get a breakout above 102, then really you have some dollar strength into the picture. I mean, this has been a clear range that we've been operating under. I mean, even 105 or 100.5, right? This was the big range here. This is another level. If you overcome 102 and you look left on the chart, the next level above that would be this one right here. What is that? 1035? Yeah, 1035, give or take. That is some ways away. Okay. That is about 1.5% away on DXY. So that'll be a meaningful one. And in that case, I would be looking to really participate by going euro dollar short. So that's kind of what I'm looking for there. So I'm going to keep this level here marked up, and we'll watch that level closely. We'll see what happens. But, for the most part here, DXY has been really holding up its strength here to the upside. You have this trend line here. We had a chance for the bears to take over and take it lower, and they failed. And the bull stepped in and continued it higher. We've had a pretty good streak here for DXY to the upside. So I'm curious to see what happens at 102. I'm curious for you guys. Are you guys thinking that we have some crowding position here on DXY and that this level of resistance will hold, or do you think a breakout is in play? I'm curious to know your thoughts there. Okay, let's see here the chat. What do you think of the market volatility right now? Well, I can say this. Stock market is bleeding today. You have the VIX higher, right? You have the VIX higher now above that 200-day moving average. Actually, this is something that I'm seeing for the first time here. So you have oil higher. You have the VIX elevated, up 10% today. You also have yield screaming higher. So the US 10 is about to hit 1% up on the day. And you have the Nasdaq is really, really bleeding here. I think, you know what? I think that volatility can stay high as long as we have these back and forth kind of conflicts with the Middle East, US and Iran. And I think that it's very probable now that Nasdaq does hit that 200-day moving average. In fact, we're getting a lot closer than I thought, really. So I'm curious to see how that plays out there. So Nasdaq to 26,000. It's looking a lot likely. It seems like it's probably about 2 days away or 1 day away, depending on considering how fast this market has been moving to the downside. The S&P 500 getting to that 7,300 mark, that may be a good buy the dip opportunity. But maybe this Fed day could be the catalyst to send this lower. You know what I mean? Like if you see this already happening before the Fed meeting, and then you see some kind of a hawkish surprise, that could really start to send Nasdaq lower, risk on lower, and the VIX continues to be elevated. So definitely watch this chart, guys. Watch the VIX to see what's going on there. How do you think today's meeting impact on oil, or do you think it won't have much of an impact? I don't think the Fed meeting, the FOMC will have an impact on oil. I think the war would have more of an impact on oil than the actual Fed meeting. So I think what would be affected by the meeting would definitely be yields, right? So the market kind of getting an understanding as to like where the Fed stands and then pricing in that. So maybe you see continued bond selling and yields higher. That would definitely, the meeting will definitely impact things like the dollar and stocks as well. Okay. So if you see, again, hawkish commentary, most likely more rotation into the dollar and more rotation out of risk on. I mean, you're seeing the Nasdaq bleed already today. So I would see a continuation of that. But as far as oil, I think oil is more affected by just the Middle East stuff. The sentiment is definitely leaning dollar bullish. Let's look at that, guys. So let's go to the Edge Finder here. And for those that are brand new to the stream, the Edge Finder right now is having a 40% off sale, 45% if you say that you're coming from the stream. But the Edge Finder does help you kind of filter out these trade ideas by considering sentiment, fundamentals, technicals, all of that stuff. It gathers all of the data points for you, and it gives you a score, bullish or bearish. There's also a lot of other things here that you can look at as well. And so to Sluggy's point, let's go ahead and look at the sentiment here for the US dollar. So let's go to crowd sentiment. Let's go to net options volume flow, and let's see what's going on with the US dollar. So US dollar right now was very bearish at one point, and it has made a significant improvement here. Still net bearish options flow, but again, in the broader picture here, you can see that we were once very, very bearish, and now we're very slightly bearish. So you can take that as you will. That is a change within itself. Let's go to COT data. Look at the latest COT data history, the latest buys and sells from institutional players. And let's see what's going on with the XY. And you can see here that we've had some accumulation. So definitely hinting at more kind of upside in dollar, right? You can see this yellow line is kind of the net there. And you can see that it's been trending higher, not only in recent times, but even from right here. Like you can see that we had a trend higher, a little bit of a dip, but then trend higher nonetheless. And so we are definitely increasing the net position to the positive side on the XY. So on the sentiment side of things, yeah, people are leaning more dollar bullish. If we go to retail sentiment and we just see the currency majors, let's go ahead and do that here real quickly. I'm curious to see what it's looking like as well. KDX, I don't know. So that is very true, but it makes me think we may be in for a surprise. KDX, yeah, that's one thing to look at there. So to your point, KDX, if you do have crowded positioning, all it takes is a little bit of mixed expectations for something to really move the market and for them to get caught off guard. So definitely worth looking at there. Let's see. Retail sentiment. Okay, we're gonna go to major currencies only just to get a pretty good look. Okay, pound dollar, long pound, and you want to take a contrarian stance with this. So the majority people in pound dollar are short the dollar, which contrarian stance means go long. Kiwi dollar, same thing. Majority are long the Kiwi dollar. Let's see. USD JPY, a lot of people are short USD JPY, which again, you want to take the contrarian stance on that. Same thing with dollar CAD, right? A lot of people are short dollar CAD. Dollar CAD is, look at this chart. I mean, it's pretty strong, right? We did have a recent dip here, but look, dollar CAD very strong there. Majority of retail is short that, so you want to take a contrarian stance. So definitely something worth to consider. Marco, how you doing, man? Sorry, I didn't see you there.
Yeah, no worries. But finish your thought.
Yeah, it seems like the market right now, as of talking, is kind of positioned for dollar strength, I would say. You have yields higher today, oil higher, 7%. DXY is marginally green on the day. You have, risk off clearly on the equities.
Oh yeah, risk off, baby. Yeah.
And then you have like net options flow. It is still bearish on the dollar, but again, you're coming from very bearish. So it's an improvement nonetheless. And then you also have kind of retail sentiment kind of all piled into dollar shorts right now. So you have a really good mix kind of pointing in favor of the dollar.
Yeah, so what I noticed is 1 week before a Fed event, usually people start preparing for the most likely outcome. And in this case, the most likely outcome is hawkishness. So kind of in the last few days or a week, you could see people start to sell stocks, buy the dollar, and kind of prepare for a possible hawkish or maybe even a sort of a dovish hike. There are many scenarios out there, but usually from following professional traders, I noticed that they have at least 4 scenarios that they build before each big event. And in this case, I think we could get a hawkish hold, which is basically, so the interest rate stays the same, but the speech from Warsh is hawkish, which doesn't mean anything, to be honest. The main thing that is important is that number. Warsh can say whatever he wants, but until they change that main number, it's not gonna do much damage. And they can do what they love to do is a dovish hike. That is essentially when they hike interest rates, but then the press conference tries to calm the markets down and become dovish and say, okay, we hiked right now, but it's sort of a kind of a premature measure. We may cut in the future if Middle East resolves, if the CPI goes down. We may cut in the future. So that's the second one. Third one is a dovish hold. So essentially that they hold rates and that the commentary is dovish. And the last one, from that I got from Brent Donnelly is that they just do a very hawkish hike. So essentially hike rates and signal multiple hikes in the future, which is the least likely outcome. So have you done any scenario thinking? What's your take on this? Maybe do you have anything?
Yeah,
to add?
my only kind of here's what I'm thinking is for the market to really start to move, it would require the fourth scenario that you said. So a hawkish hike. I think that even in the event, the third scenario that you pointed out, which was a dovish hike, the market has already priced in 2.5 rate hikes. So like what extra would you need for the market to really get spooked out? Like, I think that in the events that they hold, like scenario 1 through 3, I think the reaction is somewhat the same in my opinion. And I think for the market to really start to move would be to be the hawkish hike scenario where they do the one hike and then they commit or say that, yeah, we might have to be even more aggressive. That will be the only thing that has changed. But like the market earlier in the year already priced in 2.5. So to me, I'm like, I think in a weird way, even if they hike today, for example, like in a weird way, if they were to do a surprise hike, but then they say something like, or hint at something like, yeah, that's going to be it. I think in a weird way, the dollar will still sell off, even though it's a surprise hike, because 2.5 already been priced in. Do you know what I mean?
Okay. I can see what you're referring to. Personally, I think the opposite. I think the dollar would rally on that because I think there's only a 25 chance that is priced in for a hike. So I think just a surprise hike would be enough to push the dollar up quite a lot. But I can see what you're thinking. That what did you say? 2.5 hikes are priced in for 2026. Yeah. So that's definitely possible. So definitely another take right there. Personally, I'm going into the event long dollars, so I'm long USD CAD. It's not a lot of size, but it's not small either. If I'm right, I want to make money on this thesis, so I don't want to risk too small. What about you? Are you going mostly flat into it?
So no, I still have the gold long position, which depending on the meeting. So if the market digests everything and it's net hawkish and you continue to see yield higher dollar strength, then yeah, most likely than not, I do get stopped out here. And at that point, I would really have to consider how hawkish we go, right? Like if I'm completely wrong on this and the market just takes this and runs with it from a hawkish standpoint, if this level here breaks on gold, I'm gonna go to this chart so it's cleaner. If this level breaks on gold, you have like this clear wedge here. You could really have a squeeze lower, in my personal opinion. So that's kind of what I'm looking for. That's really all I got going into this. I don't want to flatten anything just because I don't know what it's going to be. And also, too, the other caveat is like, how much guidance do we actually get? If we're talking scenarios here, but like, I'm curious to know like what is said. Do we get any clues or not? Because the idea here going into this meeting is that there will be no more forward guidance.
That is absolutely correct. So the baseline scenario, in my opinion, is a hold and maybe a bit of hawkish commentary, but minimal hawkish commentary from Kevin or maybe the statement. Essentially, I don't think he will want to reveal much. He may be a bit unprepared for the questions because it's only his second time that he does the Q&A, and the first time he kind of got a bit carried away. I would say he let out more than he wanted, I would say, because he was not prepared. Yeah. At first he was like, no forward guidance, blah blah blah, and then once the questions started to roll in and you have millions and millions of people looking at you, it changes things a bit. He's human.
100%. I think he folded.
Yeah, but maybe he's better prepared for this attack from the reporters, because the reporters can be really they can be pieces of crap, but basically.
And look, here's the tricky part too. If you are a human being in his shoes, right? Let's say up until yesterday, you were like prepared to say what you wanted to say. Yes, we had a spike in oil, but then now we had like 3 days of consecutive down days, and it was like, down 14%, almost 15%, right? Like that was a good, you probably got in that kind of stance. And then all of a sudden, something else hits the fan, more strikes, and then oil's up 6%, 7% today. You have the stock market crashing, or not crashing, but definitely down, and you have, the VIX elevated. So that could really, really sway things. I think that within itself can cause them to kind of like fall off track and maybe spill some extra clues or whatever, because it could be something that's hard to prepare for,
Absolutely. He can panic a bit. And, today might be a shock seeing oil up 7%. He's human. So, and it's actually good for us because the more that he reveals, the more we can catch, the more we can trade it. So no forward guidance for traders, in my opinion, is worse, because the more that we know, and I told you, like, millions of people are watching the event. That's probably not true. Or most people that are watching don't have a lot of skin in the game. But for us, we can actually place bets almost immediately after the event. So we can really capture the alpha if he reveals more than he wants to. But for me, it's going to be super interesting. I already told you, Trump being the president is, I know he's kind of bad for some people, good for others, but for me as a trader, it's so entertaining that whoever is president after Trump is not going to be half as much fun. So now the question is, will Kevin suck up to Trump and be dovish, or will he actually stay true to his roots, look at the actual data, which is bad, and have a hawkish stance? That's going to be the sort of the thing to watch for today. Is he a Trump puppet, or is he his own, let's say, man? And that's what I want to see. Yeah.
I want to see that too. And I want to see if we have any more clarity, any more developments in the task force. He had some time to get his task force together. So
yeah,
curious to see if he was really about that or not.
Yeah, I'll be in the comments most likely during the event, so we can talk more about the task forces as they are announced. So far, I don't understand anything about the task forces. I just know all of the memes. So yeah, I guess we'll get more information today.
Let me ask you this, Marco. So we're seeing some real, now it's starting to be a little bit more obvious now on the Nasdaq, particularly this level of support, 28.4. We are now well breaking that level, now trading lower. Would you scoop something up here at 26.5? I think I've asked you this before, at 26,000, 26, or would you like to see even more bleeding? We're getting pretty close to that 200-day moving average. So I'm curious to see, like, if you see us break the 200, how much farther do we go?
Well, so as far as executing positions on it, I personally would stay out, because I've shifted my focus from trading the indices, well, just the US indices, to trading individual stocks, because I think I can squeeze out more percentage. And the first requirement for that is that the SPY needs to be above the 50, the 20, and the 10 EMA, which it's not going to be when we hit that support. So second question, do we have more area to slide lower, or more room to slide lower? I would say absolutely. Absolutely. We're getting a lot of earnings today as well, which is something that Nick talked about in the A1 Discord, which if you want to join, the link is in the description. So a lot of earnings are coming out, and earnings may give us a sign that something is wrong or right. So far, we saw that a lot of companies, especially Google, want to do even more CapEx spending. CapEx spending is never good for the stock price, because you're taking away value from the investors and you're promising them some sort of imaginary value in 10 years. And investors, they like buybacks. Essentially, when the company makes money, they buy their own stock, they do buybacks, and they artificially raise the stock price. CapEx is the exact opposite. CapEx is like burning money right in front of the eyes of the investors, because the returns will maybe happen in the next 10 years. Maybe. It's a big if. So because of that, because Google and a lot of other companies are announcing even more CapEx, I think investors are not happy. I just think we can slide fundamentally. We can slide a lot lower. If the Fed commits to a hawkish path, it's going to be another sort of nail in the coffin. And 200 EMA, we are approaching it. But you know what? I want to see a correction. Like, please do give me a correction. Shake out the weak hands. Give me cheaper prices so that I can make even more percentage. And I know Nick, his like wet dream is seeing the Nasdaq drop 15 to 20%.
Oh man, that's definitely one of mine too, man. And you also have Meta and Google reporting today as well after the bell, so that could definitely add more fuel to this fire, and maybe we can get some cheaper prices sooner than we think, honestly. Marco, aside from dollar longs here, I'm personally in a little bit of a pickle. So I was looking to kind of go along the Aussie basket if you were to get some kind of a high inflation print in Australia. Last night we actually didn't get that. They were cooler on all measures, so that's causing a little bit of fuel out of the Australian dollar, and so that trade I'm pretty much scratching that one off. taking that off my list there. And I would assume that most major economies are going to lean that direction as well, because you had Brent lower in June. So as they start to print their inflation prints, I'm sure they will all kind of print somewhat in that direction. So that whole trade idea that I was going to kind of go into, scratched it off. Is there anything besides long dollar that you're looking at, or are you going to stick with the obvious trade, which is long dollar, if it continues to work out?
I have one interesting trade for you, and I think
you're
gonna like it. I do.
All right, spill it out.
It's basically from Brent Donnelly from his latest newsletter. It's on bonds. So let me show you. So what most of you can trade is TLT. TLT is basically the iShares Treasury Bond ETF, and it is the price of the bond. So it has an inverse correlation with the yield, the 20-year yield. And the 20-year yield is called the long end of the bond market for the viewers. So the short end of the bond market is the 2-year. I should probably add this. So just a second. US 20. Okay. The short end is the 2-year and the long end is the 20. So the main thesis of Brent is for a hawkish Fed, a Fed that actually does battle inflation, a Fed that actually ignores Mr. Trump and actually wants to push the CPI near 2%, which they haven't been able to do in the last almost 5 years. We have been above target for 5 years. So if we do get a hawkish Fed, if we get a surprise hike, if we get hawkish forward guidance, that could give some confidence to the long end of the bond market. And that could introduce some buyers to the bond market, because we know that bond traders, what do they, let me just click this. What do they hate? They hate a Fed that is letting inflation ravage above 4 or 5%. They hate a Fed that is too dovish, but they respect and like a Fed that's actually committed to controlling, to putting inflation back in control. So if they see the Fed actually commit, be hawkish, raise rates, and say we're going to control inflation, they may buy US bonds. And the mechanics of that are that the yield should go down while the price, the TLT, goes up. So the trade is essentially to buy TLT. And we could get a high reaction if we do get a really hawkish Fed. That's another trade idea that doesn't have anything to do with currencies, and it's purely on US bonds. Now, looking at it initially, it doesn't make sense because you would think if the Fed is hawkish and raises rates, shouldn't that be bullish for the yield, meaning TLT goes down? Well, that is correct, but here it's not about the exact mechanics, and the TLT is the long end, which means the 20-year. It is about the confidence of an average bond investor of the United States government bond. And that investor will gain more confidence if they see the Fed committing to lowering inflation, which will make them buy TLT. So I hope I didn't overcomplicate it too much. I know Alan definitely understands it because he worked at JP Morgan, so you guys probably did a lot of stuff with bonds. But for the viewer, I hope I managed to explain that.
So like kind of like in a weird way, like if you were to get that hawkish kind of stance there and they're committed to doing that, they keep their integrity, they would buy, buyers of bonds will bid it up and then yields will go down. Is that something that you would do kind of like a one position type thing, or would you start to build a position? Because I would imagine it's hard to time this, but looking at TLT on a weekly chart here, you are at some lows. Now, to say that it can go even lower, definitely possible there. But with TLT here, would that be kind of like a one position shot, or would you kind of like look to build a position and ultimately try to see if TLT can actually start to get bid up here? Because you do have, I'll be honest here with you, you do have a lot of upside potential in TLT. And I know that this was a trade that a lot of people were trying to pile into in the start of 2026, when the idea was how many rate cuts are we getting? And since then, that has kind of have to shift it back. But in the event that you do start to repair this, how are you looking to structure that?
So just for the first question, this whole trade idea is about the credibility of the Fed. which the Fed has lost credibility with inflation running way above 2%. That's why the sort of the bond market has massively sold off. But the structure is just a single trade, essentially. So just a single trade, either before the meeting or after the meeting, because the initial reaction out of a hawkish Fed could actually be TLT goes down. Because the mechanics are Fed raises rates, yields go up, short-term, long-term, so price of TLT goes down. But the longer-term reaction should be TLT up as investors gain more confidence. So it's a one-off. It's a one-off position. And the probability is actually on the lower side. I would say the probability is maybe 25% of it actually going to the take profit. But the upside is a very, very high, because you have to look at it big picture. It's not about just one rate hike. It's about, if they hike right now, will they hike in the future? Is the Fed actually serious? Is this a new Fed? Is this a Fed that is actually committed to lowering inflation? That's the question that the bond investors will have. And if the answer to that is yes, the upside could be very, very high. So yes, the win rate, let's say, of this particular position is pretty low. The upside is, I would say, 3 times, 4 times, 5 times bigger than the loss.
I actually like the risk reward on that too. I mean, weekly chart zooming out here all the way, you are at some lows. So
I did take the trade with small risk.
Okay, awesome.
Yeah.
Well, man, I hope it works out. And you know what? If we start to see that actually start to happen, like maybe, I think even too, like if you were to overcome the 200-day moving average, which is what's that, like 4%, right? If you give up 4.5%, but at least you're entering above the 200-day moving average, again, you still have lots of room to the upside to go ahead and catch up there. So I like that trade, actually. I really like that trade.
Yeah, it could be the bottom. It could be the bottom. So, and you don't have to do a one-off. You can basically do structure into it kind of in the next few weeks, because September, the markets are pricing in an actual hike. So that could be pretty good for TLT to go up. And again, this is not going to be a signal in the A1 Discord, because sometimes I take these more experimental trades with very small risk just to see what happens. I keep my best stuff for the Discord. So this is just
absolutely
for fun, I would say.
Sure. Well, man, thank you, Marco. I'll be in the chat with you, man, watching the meeting as the other viewers come on, Nick and Chris. So I'll let you do your portion of the segment, guys. One more time, the Edge Finder is 40% off, so go ahead and take advantage of that. Also join the Telegram channel as well, free value. So as the meeting is progressing and things start to come in on the headline side of things, I will be posting updates on the Telegram channel. So if you have to step away or whatever, that's fine. You can still get updated to your phone or your desktop, wherever you're at. But yeah, join the Telegram channel. It is completely free, and stay tuned for all of the updates. But Marco, thanks for the great conversation.
Just one more question. Do you have 2 more minutes?
Yeah,
just 2 more minutes. So I wanted to ask you, if we get a dovish Fed today, would you be looking to enter a position immediately, and what would be the first pick?
I think I would write out my Aussie dollar position. I mean, my Aussie dollar. I would write out my gold position.
Okay.
The other one that I wanted to do was kind of go along the Aussie, but it really ruined it last night when they came out with their lower inflation print. So I would likely stick with gold long. My mind wants to short dollar yen, but I'm not going to do that. Let's see.
That's a tough one.
Yeah, that's a tough one. And probably long pound, honestly.
Okay. Yeah. I like it.
I wouldn't do it right away, just because we're below that 61.8. But if pound dollar can start to repair itself a little bit, I'll definitely be looking to add that if the technicals start to show. But for right now, the Edge Finder is still pointing bullish in that direction. The pound has really outdone itself. It's came back from the dead, I would say. So I like that trade still.
Well, if we do get a dovish Fed, I'll send you a message and we can discuss the best move from that, because it could be a big shock to the markets. Well, thank you very much, Alan. I'll see you in the chat during the meeting, and let's see what happens.
All right, man. Take it easy. Bye-bye.
Yep. See you. Okay. Let's continue with my solo segment. Let me just set up all of the charts. I'm in 2 positions: USD CAD, Swiss yen. Both are running a little bit of profit, so I would say they're break even. You can call this profit, but it's break even. If you account for spreads and commissions, it's like break even. But I still like them. I still like USD CAD long to the upside, so I'm still positioned that way, and I still like Swiss yen very much. We actually did get some stuff from GPIF. Here it is. So it's not TGIF, it's GPIF. It's the Japanese pension funds. So GPIF makes first direct private equity investment amid allocation bets. I would say it's pretty important because that's exactly what the Japanese government was talking about. They mentioned that they were going to kind of align, or let's say force, the pension funds to sell foreign and buy domestic, sell US bonds, buy Japanese bonds. The main effect of that, the yen gains strength. I can show you what happened the last time that we had something like this, which was in 2014, October. So the opposite thing happened here. Here, the government told the pension funds to sell domestic and buy foreign, and the yen. So the yen lost a lot of value. UJ exploded up. I'm betting that we get this because the opposite thing should happen. Now, I'm not sure of the timing. I don't know exactly when it will happen. So holding Swiss yen, holding a sell position on Swiss yen does make the most sense to me because the swaps are minimal. Depending on your broker, the swaps may even be positive. And I can hold this for 1, 2, maybe even 3 months. And we will see what will happen. I know if you zoom out, I know this chart just goes up. But hey, I'm not asking for a full-on reversal. I'm asking for a pullback like this, let's say to maybe this 20 MA, right, on the monthly, something like that. So a pullback to maybe 190. Well, maybe even higher, 195. I would still make a lot of money. So 195 would be fine. Just a pullback for me. Let me check the SPY. So the SPY, red, Qs are red, RSP. RSP, by the way, is the S&P 500 equal weight ETF. This is what is kind of actually showing you what's going on behind the hood, you can say. So is it a complete sell-off or is it just a rotation? You will notice that in 2025 with Mr. Trump and Liberation Day, the RSP went down massively. But right now, the RSP is at all-time highs, while the Qs and the SPY are struggling. They're flat or outright bearish, which is a big issue, okay? So, which is a big issue for the Qs and the SPY, but the RSP being up means that there's a rotation. There's probably a rotation out of tech and into other sectors. What would confirm a real bear market to me would be just a breakdown of the levels on RSP. So thank you, Sluggy, for pointing this out. RSP still looks pretty strong, and this is kind of the last fort that is standing before we confirm an actual bear market. The Qs look like shit. The SPY has been flat and range bound, doing nothing. RSP is the only thing that is holding up. So yeah, and you may be wondering, why is the SPY flat? Well, because the SPY is heavily overweight on tech. So if the money flows out of tech and into other sectors, the SPY will suffer, while RSP, or the equal weight, will continue grinding up. Okay. Anyway, Fed is today. Very, very important event. I would say the most important event after COVID, war, financial crisis, Liberation Day, new president, and events that basically are one-offs, kind of like black swan events. So the Fed meeting is the second most important after all of those. Today, we don't get the future projections. The future projections, they come out 4 times per year. You get the approximate interest rate in the future, or you get a projection of the approximate interest rate. That is not coming out today. That's coming out in September. So on the next meeting. Today, we just get the interest rate decision and we get the speech from Warsh. I covered most of it with Alan. Personally, I'm betting on a hawkish hold, if I'm being honest. So I'm positioned long on the US dollar, which does make a lot of sense in my opinion. Damn, Aussie dollar is just melting. What is happening with AU? Why is it melting so much? I don't know. Can we get the Aussie AU 02 yields? Let's see. Do we have the 20? Yep. Okay. What about the TLT? TLT not looking so great on the day, but that's fine. So that's how I'm positioned. Now, I'm thinking we get a hawkish hold. We could also get a dovish hike. The Fed, if you study previous Fed meetings, the Fed is famous for doing a dovish hike. So a dovish rate hike is basically when they hike interest rates, but they have dovish commentary to kind of soften the blow. So you get initially a surprise, the markets rally, or in this case, the dollar rallies, and then you get the meeting, which is dovish, which kind of tames the market. So it's damage control, basically. The meeting is then supposed to be damage control. It would be the perfect scenario for me. A dovish hike would be perfect. I think USD CAD would really love that. But we don't know. We're going to have to wait and see. I do want to mention the sponsor of today's show, which is going to be Ola Prime. So if you're looking to get funded, let me show you. Ola Prime is 20% off with the code A1 Live. So 20% off with A1 Live. Do research. Their Trustpilot is the first thing you need to do. Whichever prop firm you're looking at, Trustpilot is the first thing you need to look at. The number of reviews, what is the score for this niche, compare it to the niche. Then you compare the ratio. What is the ratio of 1-star to 5-star for this niche, which is prop firms? That's pretty good. Then you scroll through the reviews, you read a couple of them, and you see what's up. Okay. Next step is join a Discord. Join some sort of a Discord where you have traders that actually got payouts from a specific firm. I know from Ola Prime, we have a couple of members in A1 that got payouts. They mentioned that they had pretty good experience. That's why we recommend them. And that is why we do partner with them. So with the code A1 Live, you get a great price, 20% off. There's no consistency rule. No consistency rule, which if you're a swing trader, this is a must. Okay. If you know anything about the consistency rule, it's absolute shit. If you're a swing trader, it can really mess up your strategy. So no consistency rule is kind of very, very important for me, at least. Maybe you're a scalper, maybe you're a day trader, so it doesn't matter much to you. For me, it does matter a lot. Okay. Comments. Let me see. What do we have as far as comments go? Gabe says, Marco, at the beginning I didn't like you, but now you're my genius. Well, thank you. Thank you. I'm glad to have changed your mind. Hopefully I don't change it back to you not liking me. You're expecting a hike as well as metals on the rise. Sell gold. Gold. We should probably do gold. I know a lot of you. So a lot of you love gold. A lot of you bought gold. A lot of you are still buying it. A lot of you are getting stopped out. Just the reality. Personally, I'm bearish on this chart. It is above 4K. You have a trend line running through here. So we seem to be stuck in a range. We seem to be doing nothing from the 25th of June. The fundamentals that I currently have in mind, the fundamentals of my positioning, meaning for a hawkish Fed, is bearish for gold. Higher interest rates are bearish when it comes to gold. So I would like to get a break of the 4K level. You have the 4K level right here. It's a crucial level. It's a big round number. Do remember that humans love round numbers. Okay, we place a lot of importance to round numbers. But if this breaks and if the Fed today is more hawkish than expected, it's game on. I would say actually one of my favorite plays would be to sell gold. I think the retail interest is gone. I think this chart goes down. If you look at the correction, it's not big enough yet. From the peak to the trough, 30%, that's not big enough. Look at the previous ones. So look at this one from the peak, 45%. Let's find another one. Ooh, this one is juicy. Oh, yeah. Let's see. Whoop. I misclicked. I'll be back. Better to go to the monthly, I'm guessing. Yeah. From the peak, 70% correction. So we ain't seen nothing yet. This correction is too small. By the way, if you do some backtesting, usually when gold rallies 70, 80, 90, 100% in 1 year, the next year is break even or negative. What does that tell you? Well, it should probably tell you not to be bullish. So that's my opinion on it. I know different traders have different opinions. I know Nick tried to buy a couple of times. So that is completely fine. It's his decision, but I'm looking at the evidence. I'm looking at the fundamentals. I'm looking at the chart. I'm looking at the retail. I'm looking at the comments. So sorry, guys, but in the comments, if you guys love gold, I'm looking to sell it. Okay, it's just the reality. 95% of retail loses money. So, and we have a lot of new traders join because they came into the markets in 2025 because they got interested in gold. But guess what? Everyone was a beginner at one point in time. I was a beginner. I lost a bunch of money, but I learned. So thankfully you're here, so you can learn. And what you should learn is that markets like this don't tend to repeat themselves quickly. You usually need to get a few years for the retail to forget about all of the losses that they took here and that they bought the top, and then we can reset. The mentality can reset. It's not just for gold. It's for Bitcoin. It's for SpaceX. Have you seen SpaceX? I love it. I love to see a company that loses money get crushed on its crazy IPO pricing. I know the rich will only get richer, but I just love that this is coming to a more fair price. So hopefully it can hit 100. I think it can, especially if we get that bear market. And so far, one of the worst IPOs. My condolences to the guys that bought the top. Hey, we have all been beginners at one point in time, as I mentioned. So a lot of retail players have bought the top because they are riding the something from Elon Musk, which is fine, but it's not an investment strategy. You need to know that this company on paper doesn't make any money, and that the valuation of 150 or what is it, 170 is crazy. It's overvalued. The fair price is 100 or below. The fair value of the company is 100 or below. So a lot of retail got in here, they bought, and now they lost a lot of money. They got burned. 50% correction. It's pretty bad. And those guys are not super happy to jump back in. So it looks like the retail this year is just getting crushed, which means it's not going to be a great situation out there. Feels like the market is ready for a dovish Fed. It could happen. Absolutely. It could happen. I'm with you on the gold crash and DXY buys. Marco, can you explain why gold is acting as the opposite of a safe haven in this current environment? Yeah, absolutely. And that's a valid question. That right there is an absolutely valid question. So you would think there is currently a war. Russia, Ukraine, US has attacked Iran. Iran is fighting back. Tensions are high. Oil is going up. That is considered risk off. Why is gold flat? Why is gold overall bearish? The reasoning is that gold has become more of a meme stock, or more of a meme stock rather than a risk-off asset. What do I mean by that? Well, you had aggressive buying in 2025. You have a lot of retail that got sucked up into buying gold, especially buying the top. Wall Street Bets was highly active during this period. So because of that, gold was highly overvalued. Highly overvalued. We have experienced the cycle. And there's not a lot of smart people that want to buy at these high prices. They just think gold is too high and they don't want to get in. They are probably expecting a deeper correction because this move was so crazy. Second reason is fundamental. The Fed controls interest rates. Interest rates kind of control the price of gold. If interest rates are going up, gold is going down. If interest rates are going down, gold is going up. So essentially, most of the market believes that in the future, the Fed will be more hawkish. And most of the market thinks that the rate hikes are coming. If we look at Fed Watch tool, let's see. So by the end of this year, we have 2 hikes priced in. Current rate 350, target rate 400. Okay. So the Fed is actually more hawkish, which is bearish for gold, and that's bearish fundamentals. Just a second. Just 1 second. Okay. The IPO was SN9, I guess. I don't know what that word means. English is not my native language, but it doesn't sound good, so I agree with you. China and other Asian countries buying gold, US fighting wars, the crazy thing. If you draw a trend line from the double top, it's possible gold goes to 4,500 before making its full correction. Golden rule, never buy IPO, buy it in 6 weeks. Yeah, absolutely. With IPOs, the research is telling you that the first 12 months will underperform the index. It has, like, the past research studied hundreds of IPOs, and most of the time, the IPO actually loses money or goes below the opening price for 6 to 12 months. It's better to wait for a couple of months, or you can buy the bottom. If you can identify the bottom, which I think could be 100, could be a good level to buy initially, that could be a good investment strategy right there. So for any future IPOs, just so you know, buying an IPO on IPO day is a losing proposition. There's a lot of sharks here that are there to take your money, that have studied how IPOs move when they happen. And the whole purpose of those sharks is to take money away from the retail. And they are very successful. So I would highly suggest staying away from trading IPOs, waiting a bit. Anything on UJ? That's actually an interesting thing to look at. USD JPY. So USD JPY. I'm bullish on the dollar and I am bullish on the yen. So I'm bullish on both currencies, which means I don't want to do anything here because there's no polarity. If I'm buying the dollar, if I'm buying the yen, it doesn't make sense to buy or sell USD JPY. What makes sense is to buy USD CAD or to sell Swiss yen. Okay. So personally, I don't have a big edge here. I don't know what you can exactly do here because you can buy USD JPY. I think the dollar strength is going to be stronger than the yen, especially until we get some sort of movement out of Japan. We either get the Japanese government to do a surprise rate hike, or we get an intervention, or we get the GPIF to aggressively start selling foreign and buying domestic. So, but that hasn't really happened yet. So in the short term, this chart is bullish. You can collect positive swaps, which is fine. But personally, I would just be too scared, if I'm being honest. I would be too scared to buy this because, again, the Japanese government, they have free tools at their disposal. So surprise rate hike, intervention, and what else do we have? GPIF, pension funds. So they have free cards that they can play, and trust me, they want to play them because the yen has lost too much value, and you never know when this will happen. Looking at the yen, looking at the JXY, look at this chart. It doesn't look good. It's just going down and down and down. The Japanese businesses and individuals have lost a lot of purchasing power during this move lower. I noticed from my research that the Japanese government is losing popularity in Japan. So the Chinese Trump, or not the Chinese Trump, the Japanese Trump, which is Takaishi, this lady right here, she's called the Japanese Trump, is losing popularity, and her party is losing popularity. So to help themselves, they may want to push the yen up. And that's basically the bet for Swiss yen. That's why I have sold Swiss yen. Gold is a safe haven for Arabs and Asians, so they sell it when they are in need of economy is bad. Gold was being sold. To trade the interest rate? No, I don't live trade the Fed. Well, maybe sometimes if there's a real edge behind it, but mostly I like to position myself either a couple of hours before the Fed or maybe a couple of hours after. That's how I usually play that. Okay, I see Chris has joined, so I'm gonna wrap it up. Japanese lady PM is a creep. That's funny. Anyway, summary. We have the Fed today. I think they turn out more hawkish than expected. That's how I'm personally positioned. I don't think it's going to be a huge event. I think the big one will be in September, where the market is expecting a full-on rate hike. So do watch the conference. Do join us on the stream. I'll be in the comments. It'll be pretty fun. So yeah, I'll see you in 2 hours or an hour and a half, something like that. And don't go anywhere because I have Chris coming on in 30 seconds. Thank you for watching and see you in the next one. Goodbye.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody. Welcome to a little FOMC day. Well, we have some pretty key levels to watch. The market is testing the lower side of our last couple of weeks. 7375, 7400 key support for the S&P right now. The dispersion trade continues. The IV continues to stay higher and elevated for the Nasdaq. We've seen a bit of a bear market in chips and AI plays, with those being down 20+%. Look, you still have stocks that are up over triple digits for the year. Micron's had a 20+% pullback, and SanDisk and Western Digital, they're still up triple digits for the year. Does that mean the trade is dead? No, but it means it's rotating. Something I thought was interesting is, we've talked about this before, but look at market breadth. Okay. The S&P market breadth has improved a lot. This is a big reason that, the S&P is only a few percent off all-time highs. We're at 71.5% of stocks in the S&P are above a 50-day moving average. That's impressive, right? This dispersion trade that started in 2026, really. This is the decline where I'm kicking myself for not being more aggressive, but my market breadth timing indicator was not where I wanted it. It was down to 18% when I was looking for 15 or lower to get long. Obviously I'm kicking myself in hindsight, but it's look, I've had very good timings of this market breadth bottom, and that little bottom in March was just not at the level I wanted. So it is what it is. We're barely up to all-time highs after, you essentially had like a 45-day window to get there. You had some chip stocks to trade, and if you weren't participating in about 20 stocks in the entire S&P, Nasdaq, the concentration of the semiconductors, if you didn't take any of those like high flying stocks, you're just kind of treading water. If you bought the bottom, great. You got very lucky at a 9.9% correction that was the bottom. We're still in an elevated geopolitical situation in the Middle East. Oil prices are all over the place. I know there's a lot of macro analysts that are very long oil right now. Look, I'm long scarcity. I think that, energy prices will continue to be higher and stickier. Commodity prices in general, we could have some bottlenecks in scarcity over the next like 6 to 12 months as just more stuff happens. But the good thing is, under the hood, a lot of this rotation is, I think it's a healthy look for the market. So to me, this is a rotation story more so than a bubble story. So anyone that thinks like this is bubble stuff, it's like, I'm just not buying into that narrative. I think this market, as you hopefully have seen over the last 3, 4, 5 years, especially, climbing the wall of worry is what this market does very, very well. Yes, global yields are rising. We're talking about a Fed that's brand new. They're putting on this 6 months task force to basically tell us that, the Fed's backward looking and lagging data is going to be maybe a little bit more refined and reformed into, the coming years. It doesn't mean there's not short-term volatility ahead. It doesn't mean there's not noise ahead. I think if anything, this is the reform that Kevin Warsh wants to see, as far as his legacy is all about reform versus like transparency and telling the market exactly what the Fed's going to do. So he also bought himself this window. I mean, if the Fed does hike rates in September, the market may not love it. As Marco just said, I mean, if the market does react more negatively in September with an official rate hike, then we'll deal with it. But I still think they're going to try as hard as they can to get as much free mileage out of talking hawkish and not have to raise rates, because typically a rate hike cycle just adds a lot of pressure to the growth story. Even if you hike and pause after that, it's still the one-time shock the market's going to have to figure out how to price in. If it's a multi-hike story, like 2 to 3 hikes, which Bank of America is calling for, we'll see. I'm seeing right now that the macro side is saying that the Fed is essentially 2 to 3 hikes behind the curve, based on our current yields that have been on the rise. So that's I just said, market breadth story is interesting. The rotation story is interesting. We can talk gold, silver, Bitcoin, oil, indexes, things like that today. We also have earnings today after market. So it's Mag 7. We're kicking off with Meta, Microsoft today. We have Apple, Amazon tomorrow. We have Big Energy on Friday. We have a lot of stocks in the next like 4 weeks, lots of earnings. And if the market has been this tight and choppy, I think that in an interesting way that we could have some like blowout earnings, like both to the upside and downside. I think that the expected moves are going to be relatively underpriced. So I wouldn't be surprised to see that there's more, prices move well beyond what's expected. And so that can make for some additional like dispersion and additional volatility in these next like 4 to 6 weeks. So, all right, there's some market breadth stuff. Let's talk top down. Let's go SPX. It's essentially the same chart we've been staring at for weeks. We have been dancing around and lingering around this 50-day moving average. Today's body of the candle is pressuring a little bit lower. Today's low so far is 7341. I'm going to label one of my charts here. So I got filled this morning. I have a 7280. 7280 is my iron condor today. And then up above this, I think I'm at 7520. 7520. Okay, so if price is going to stay below this line, above this line, I have some profit on the day. In addition to that, I'm going to, I've got defense kicking in around 7310 and 7505. So 7310, get a box drawn here. 7310. Okay, so I have some defense in there. Did I go 25 wide? 10 to 90. Okay, so that's 20 wide. So I could probably take this down to like 90. Yeah, that's good defense. All right, so there's defense there. And then 75. 75.05 is where it kicks in up here. 75.05. There, little defense. So what I'm doing is I'm mapping out my charts for the day. So if price is going to stay inside of that range, the defense doesn't matter. The defense doesn't matter. I'll take the overall profit. It's going to be worth $3 profit. So that's $300 per contract. And that's if price stays range bound. And today is just a, noisy Fed day. So I'll ask the question. Where do we think we're going today? Do you think this market is down for the morning, up for the afternoon, and it's going to finish like a big fat indecision candle, classic Fed style? Or are we going to have additional follow through, which Kevin Worst step? I mean, there's still a 65% chance there's nothing happening today, right? It is kind of interesting that the Fed watch tool, 66%. I mean, the fact that people they might surprise us today. I'm like, this tool hasn't been off since 2009. So, I mean, I get it. Maybe he's convinced all members of the Fed to vote for a rate hike today, but I highly doubt it. I think that this is, it's a big deal. Like a rate hike is a big deal, right? And the percentage in September still remains at 57% that we're going to hike. So is it a one and done? Maybe, but the bond market has to listen and we'll see. Global yields are still on the rise. The reason I'm paying attention to this so closely is because I believe the market is quite vulnerable to the downside. So if the market's wanting to run on this idea that the Fed is in fact looking to raise rates and do a rate hike in September, the market might front run it. And whether that happens today or for the rest of the week, we still have earnings. So if we have the Fed, and let's say the Fed is ultimately putting more of a bearish tilt to the market, but then you have earnings. Okay, you have earnings, which are all positive. What does that actually look for as far as index price action? Markets want to go down on the Fed, but earnings are more important right now. The markets could look through the Fed and say, yes, there might be a rate hike, but earnings matter. Earnings are still good. We're still in a healthy economy, healthy bull market. So this could just mean more indecision, right? And this indecision that has been driving, a lot of traders crazy. There's still lots of trading opportunities. What I've been doing is, as you've seen in the Pulver alerts, selling lots of premium. So where at? Down here at these March lows. If I get a high enough flash in the VIX, I'm going all the way down here to not April lows don't pay me as well, but I'm going all the way. This is Liberation Day stuff, but I'm going all the way back down here to previous highs around 6,100. So between 6,300, 6,100, 6,000. I've been playing a lot of those levels this year just to pull in, for every trade. It's like pulling a couple $100, stack up, I don't know, 50 of them, 100 of them. It still pays the bills. I just need some time. Time's on my side. This market can chop sideways. I don't have to pick a direction. It's just churn, just disperse, stay up here, be choppy, be indecisive, and I'll still get paid. So pretty conservative on that. Okay. Nasdaq. The Nasdaq did burn off about a 10% correction here. Certainly more vulnerable. Couple levels to watch on Nasdaq. Again, highly concentrated in the chip space. Large tech. Mag 7 also kind of underperforming. I'll come back to the NDX in a moment here. Mags. So we have this March to June high. One thing that's interesting is we might be looking at something like this as far as the mags go. Right? They could have stellar earnings this week. Maybe it's enough to thwart off this little decline and work its way back above the 200-day moving average and maybe fill this gap. I would still think that mags in general are going to face some growth concerns because it's hard for these companies to still keep outperforming and beating with huge clips. So if we rally back up into the middle or we rally back to resistance, I wouldn't be shocked to see this is how it plays out. That's dispersion still. That's indecision still. Not necessarily, oh my gosh, mags are crap. Oh my gosh, mags are going to blow off the top again. I think we're going to deal with a lot of like a meat grinder market. Okay. So we'll see what happens. Meta, Microsoft, Apple, Amazon this week. We had Google, Tesla last week. They were punished a little bit. The trade I took on Google did pay pretty nicely. So Google is up to 337 of this $1.50 ratio spread. I closed it for 1 cent. So I pulled in $149 per contract. So 149 out of the max 150. 99.3% of that trade was closed out before expiration. So this is where I think a lot of the Mag 7 price action might be, is it has a knee-jerk reaction one way or the other, and then it neutralizes. So, I mean, do you think that Apple at all-time highs is going to have terrible earnings? Probably not. Do you think Amazon's going to have terrible earnings? Probably not. Do you think Meta, Microsoft will have terrible earnings? Probably not. Right? Depends on what they talk about as far as AI, CapEx spending, cash flow. Are they issuing debt? I mean, that's what the market didn't like. This is the first negative cash flow quarter that Google's ever had. Market didn't like it. Tesla spending lots of money on AI and humanoids. Market doesn't like it. Right? Despite car sales being better and deliveries being better. Yeah, I mean, I think Mag 7 is still just it's a financing source for everything. People have had, great success with Mag 7 the last, decade. And now it's that hard decision of like, do I keep Mag 7 stocks in the portfolio, or do I start taking off some profit and going elsewhere? Am I chasing more AI stuff? Am I rotating into other things? Like it's a really interesting year. Like, I mean, I think the mindless robot trade has been doing pretty well these last 3, 4, 5 years. Buy every dip, every V bottom. But today, or this year, is certainly the rotational feel. Okay, but I think Mag 7 will still be like somewhat noisy. I'm playing kind of the expected moves on a lot of them. So today, let's see, Meta and Microsoft. I think I'm covered to a move about like this. So if price doesn't go too high or too low, I'm covering most of that move. Microsoft, same thing, covering most of that move. Let's go to the NDX. So because we've had such a little correction in the S&P, the Nasdaq has mounted a double-digit correction. We are down about 11.4%, 11.5% almost. Creeping into the 144 moving average. Here's a 200 EMA. I mean, if you look left on the chart, past resistance, could it become support? Very possible, yes, right? Little correction. If you're going to be patient, do you want to, take a stab at this with a tight stop loss? Do you want to wait for better confirmation? Do you want to see if the market will come down and test the 200-day and then bounce off of it and see if that is a, bottom that gets put in? Or is it going to be more of like the difficult, bottoming formation instead of just a sharp V bottom? Okay. I am playing a lot of these, Nasdaq trades that I'm in, QQQ trades I'm in, XND trades that I'm in. I'm trading them out here. So even if this is a noisy spot, I'm trying to trade with this is like, okay, I would take some ownership of QQQ here. I would go even lower and take some assignment. But if we have this as a, rally, pullback, market chops around higher low, lower high, or I guess higher low, lower high. If this wedges, it's just more of the same. I think we have a, August, September is a very vulnerable window for the markets. I've been saying that now for weeks. I'm, realistically nervous for the next 60 days to think like we could have some really outlierish volatility event that might equal a cleanse. It might equal V bottom, but I think it could be very disruptive to like, oh my gosh, the market's down X%. Insert something double digits, like market's down 10%. This is already down 10%. So could we go to 20? This correction is 26%. So could the Nasdaq be down into bear market territory, but still be a V bottom? Yep. Could the S&P drop 10% from these recent highs and, and look a little bit deeper than just a correction? I mean, yeah, we could have a scary, scary move. So this has been handled very well by the S&P. The Dow, and I mean, honestly, if you're watching this, this is equal weight. To show how well the market's rotating, equal weight is looking to perform the S&P for the first time in like, I think 4 years now. The last time RSP outperformed SPY was 2022, which if you think about it, why was that the case? Because, I don't know, the market's down 30+%. Equal weight was down, but it was down less. So it outperformed by being less sucky. Okay. So anyway, equal weight is just off all-time highs. Dow, another chop trade near these tops, but certainly looks a lot different and better posture than Nasdaq. It's only down about 2.5% off the highs. The Russell continues to be this little small cap engine that could, and it's only down about 4.5% off of highs. I think the posturing on the Russell looks fantastic. So am I interested in buying dips on the Russell? Yes, I'd love to buy dips in the Russell. Okay. Do I want to buy it right there? Well, if I do, it's going to be defined risk. If I'm going undefined risk, I'm going out here, or all the way down here. Liberation Day is a long time ago. March lows are not that long ago, but I'd say that's probably where I'm playing, If we get a bounce, like play it a little bit more conservatively, try to get into this profit target. I'm still bullish at like 305 to 325 profit targets on IW1. Okay. All right. VIX today is a 19.3 VIX. I'm just going to throw it out there. If that stays about the same, 19.3 VIX is a 1.21% move, plus or minus. That's an extreme, but that's about what we could see on the day, is like plus or minus 1.21%. What's the market had so far? The market has had a sell-off. So we opened up here, slid down about 1.04%. You can see we've neutralized a lot of that move. From the close yesterday, market was down about 1.17. Is it a shock to see that my calculation is 1.2% and we stopped around 1.17 to find a bottom on the day? No. So if the VIX doesn't spike up any higher, like 20 plus, this might be the bottom of the day. We might come down to retest this bottom. We might come back and, fill this gap, and it's just a big fat indecision candle. That's what FOMC is a lot of the times, is just nothing but noise. Okay. This is a bit of a concern. I'm going to go to a different chart here. Let's go VIX, SPX here. SPX, let's go this chart. Let's go to move index. So this is the bond volatility index, dollar index. What do you like? You like long dollar, short dollar? I mean, risk off gives a good push for long dollar. I just think it's going to be noisy, but we've made higher lows. If we pull back to the 50 period or the 200 period, I think this still has a support structure underneath it. Risk off, if the dollar gets stronger and maintains a bid, I think this is a risk off tone for equities. That's why I think the market has also been sideways, is we're choppy in equities and we are choppy in the dollar. The market doesn't know yet. The market doesn't know if it's going to be a risk off, which would be down equities, up dollar. Okay. U.S. oil, extremely noisy. Who thinks oil is going back to $100 or more? Type it in the chat. So are we going greater than $100 on oil? Or are we going to find a new range and basically be like, 90 to, let's say, 60? Like $60 to $90 is a lot of noise, but it may be the new range. We had this range for a while. And the reason I think it's going to be difficult, okay, the reason I think it's going to be difficult, outlook outside of this trade right here, I'm going to build out this trade just for fun. If we think oil is going to go to the freaking moon, I mean, what could I trade that's going to be cheap and nothing but ridiculous profit potential? Trade an option on USO, or trade an option on oil futures. And if this thing like rips up on some type of oil squeeze, it could pay very well. But it's like, I need that to be small risk. Okay. Now, the one thing that we haven't talked about, and I think you need to acknowledge, is SPR is Strategic Petroleum Reserves. Why does this matter? The reason that prices went down is because of the release of this. And it wasn't just the US, it was global. And I get it that we've depleted a lot of our reserves. It doesn't mean that we don't have more. Okay, it doesn't mean we're not trying to replenish it. But globally, I mean, when you have China that did this, as well as the US and other countries, and now you have other countries like, well, we need to have those too. We need to have some SPR. That's kind of the case of like, well, that's where oil prices can go up. I don't know if we're going to get the big oil shock. I mean, I would say we're more on the brink of a recession, and possibly way worse than that. If oil shocks to like 100 plus again and stays up here, I don't think we're going to be anywhere close to all-time highs in indexes. There's going to be so much additional pain in the equities market if we have a big oil shock again. So I would be, I'd be a little bit more surprised to see oil go way up here anytime soon. I mean, kind of classic taco style. It's like Trump could, if oil prices start creeping up to 100, there's probably going to be some short opportunities with Trump being very vocal about it. Ceasefire this. We're done with this. The war is over. Blah, blah, blah. We've been told that for 100 days. Yeah, here we are. We're at 80s. So I'll look at this. Let me look at oil futures. See if this is something somewhat cost effective. Oil futures up here towards like 115. Okay, let's take a look at it. So oil futures to 115. If I go out to, I mean, what's a good time to trade it? May. Just go out. Give me some time. I don't know how expensive it's going to be, but let's find out. 115. It's out of the money. It's going to cost, maybe a couple grand if I did a 115. This is ridiculously out of the money. But a 115, could I spread this thing? I mean, if I want to make this like a cost-effective trade, I could do something like this. Buy a 115, sell a 122, basically have about a $7,000 profit trap for a $250 risk. Now that trade, I want to build this out. I mean, if this is what I'd like to see is time-wise, is this is all the way out to like 290 days. If price were to go up to 110 or 115 again, this trade is going to be profitable, likely greater than 100% return on risk, but not anywhere close to the max profit. So realistically, if I turn this $250 into, let's say I can turn this into $500 profit. I risk $250 to make $500. It's 200% gain. If I can make anything over $1,000, get a 4-to-1, I think that's a good risk, right? Take the risk to make the reward, and that's, call it a hedge, right? Call it an energy hedge. Call it a freaking, we can't get this crap solved in Iran and oil's doomed to go up again. Maybe it is. So it's a cheap hedge and could pay very well. So anyway, that's a thought. Talking about it out loud, it's maybe something I'd be interested in playing. If I wanted more upside potential, maybe I can spend a little bit more for this. I think this is a very low probability trade, but if I want to say, let's put $450 at it, I can make $14,000+ to risk $450. Like, it's a pretty decent return, right? I'll just say this. It's a 29-to-1 opportunity. Even if that thing gives me 2-to-1, 3-to-1, 4-to-1, it's still pretty good. Right? So it's very cheap to take this trade, but it's a low probability win. I mean, IV rank is 39.4. I mean, you're talking global SPR. You're talking a president that is single-handedly moving the markets when he wants to. It's a press conference. It's a talk. It's a headline. It's a soundbite. It's a tweet. I mean, you think Trump wants to see $120 oil? I mean, probably not. Not without jawboning the living crap out of it. So make it inexpensive, get a ton of upside, and if you get this crazy squeeze on it, then great. Right? Do I love this trade for probability? No, it's a terrible probability. But if we get a squeeze in oil, it could pay very well. So anyway, food for thought. Gold and silver. Okay, I sound like a broken record on my analysis on gold, which is I get it. We have a pretty terrible looking chart. We've had a death cross. Use a color here. We've had a death cross. Okay, 50 crosses the 200. We're kind of bottoming out here. I think there's more upside potential than there is downside potential, even though this market may not be done correcting. Okay, I am prepared for like gold to head down to maybe 3,500 and maybe 3,000. Okay, I say maybe because, if we're going to hang out here and round out this bottom and break this structure, then maybe gold does get a little relief, but let's see what happens at this channel. If we hit resistance, future resistance, let's see what that looks like. Okay, the more time this spends consolidating, okay, it might pop, it might come down to retest, but that could be, to me, where the bottom really kicks in. I am still, like, medium to long term, very bullish on gold. If the U.S. government or the globe turns to printing money, especially, gold's going to be a great beneficiary of that. Bitcoin could be a great beneficiary of that. It's like the alternative of stop printing money. Other stuff looks more attractive. Gold could be that attractive. Silver as a strategic metal could be good as well. There's an AI narrative to that as well. So we'll see. But, certainly looking for a bullish pattern on gold. I think that central banks are, wanting to try to park money into gold. They're trying to move away from U.S. treasuries. I think big picture wise, and this is scary stuff, it's like there could be a massive fiscal reset. There could be a massive debt reset globally. But the reality is we're all in the same boat. The whole world is cheap money, printing money, monetary policy, fiscal policy is now the big thing. This is the repatriation that we talked about. This is why I think that the one black swan. It's hard to say it's a black swan if we're talking about it, because it's not something that's out of the blue. But the Japanese yen could be one of the most like one of the most obvious risks in the market is if the Bank of Japan flinches, or the the Prime Minister flinches. Man, we could send the Nikkei into a tailspin. We could send the U.S. markets down with it. The carry trade unravels. I mean, you got a little morsel of that in 2024 from July to August. So that's, and again, why am I hedged on that? I'm long FXY. I'm still long the Nikkei. Just because I think that they want to keep the Nikkei going higher. They've been in a 30+ year drawdown, so why would they want to see it top out? So Nick, my man, what's up, dude?
Hey Chris, good to see you, man.
You too. Happy FOMC day.
I know it certainly is a big one today. I feel like this is maybe the first FOMC in a while where it feels like really it could swing either ways, right? You could have like a lot of times the market's like very sorted out ahead of time, but with the kind of less forward guidance stuff from Warsh, it'll be really interesting to see how everything shakes out. I mean, clearly markets are in kind of sell mode recently, especially tech stocks. Just looking at Nasdaq, this thing has shown some weakness. I don't know how much more there is to it. I would not be surprised if we did continue to roll over. Some of the Korean stock market sell-off stuff is gnarly out there. Have you been watching that?
Yeah, Kospi, SK Hynix, like, dude, they look awful. I think that's why the weight. Sorry, I spilled a beverage, so I've got to.
Oh, my bad. I didn't see you do that. I can give you a moment if you need it.
No, I'll keep talking. But yeah, the South Korean stuff. I just think it had its time in the sun, and now it's like it's a reality check. It's like they did so well. It's up a ton. This is so bad. Let me do this. Give me a few minutes, dude. Let me just.
Yeah, no worries.
This,
I got you
on my computer and stuff.
I got you. I'll back you out and come back in when you're ready. Yeah, guys, just to reiterate where we're at with that ginormous run up in South Korean stocks, unbelievable gains. And it's been the story here. I don't know how many of you guys have been here, regular viewers for a long time, but Chris and I were watching, the gold move that happened in January of 2026. And it was like mind-numbingly, peel your face off rally on gold that was just a never ending, every single day we were up another couple percent on gold. It was unbelievable and incredibly rare. Then when the top was in, like you had just unbelievable selling the other direction. And for a while, it's felt that way with semiconductors. And it does feel like that is still the story. That is the narrative here with semiconductors, is they were invincible. They were every single day the winner. And now they are, rolling over. And I think that if you're looking at this from a moving average perspective, which we often like to do, you've got like the 200-day moving average still a good ways away. Like you could still see another 12% downside in the SMH, that's the semiconductor ETF, before I think you even kind of get to a quote unquote fair value on a technical analysis basis down here at, like, let's call it 450 per share. When we take a look at obviously the Nasdaq here down the most today of the, well, actually I take that back. It is down 1.06%, but you've got Dow Jones down more. You've got the Russell down more. S&P 500 holding up a little bit better than the rest, but it is very interesting to just see the index level kind of SPX still holding up relatively well, despite everything that's been thrown at it. We'll see what happens with rates today. I think the interesting story here with yields moving higher, the 2-year yield pushing higher here, the market seems very prepared for the possibility of a rate hike today, which I think would set the tone of the Fed. We have Jackson Hole Symposium in August, I believe, which brings in a whole nother question of, like, oftentimes Fed chairs have historically used the Jackson Hole Symposium, which is it's the biggest Fed meeting. They use that as the opportunity to kind of let out their narrative a little bit more. So really will be interesting to see. Fed commentary, I think, is front and center for the next 1-2 months. and we'll continue to watch it. Gold up a little bit here today. I'm curious to see how things shake out. We also have the Middle East. Certain uncertainty still abound there. Oil's back up 7% today. Big sharp rally. Of course, just after I got stopped out of it. That's how that goes. But all good. I'm going to continue to watch this one, and we'll chug along. I think for me today, going into the meeting, I am pretty neutral on a lot of stuff. Like if I'm looking at the dollar index, I'm looking for guidance here today. Like the dollar index has been kind of range bound here for a little bit. Inflation has been a mixed story, because if we're looking at, for example, if we go to our asset scorecard here, check this out, right? So if I go to the US dollar, I've got a really mixed reading, because on one hand, inflation was cooler than expected, which is bearish for the US dollar. But at the same time, institutions seem to be piling longs when it comes to the commitment of traders report. We have a solid overall upward trend. Yields are moving higher, suggesting hawkishness. So I just have this checkerboarded effect. And I think it's okay to acknowledge when you do have that, right? So right now, when I'm looking at DXY, I'm feeling very neutral and looking for some guidance today. Because if you get from the Fed something ridiculously hawkish, if they hike rates and issue that they are going to, focus first and foremost on inflation, and they really harp on that, the dollar index could see 102, and I don't think that that's a significant thing to say we could see if that happens. That said, on the other side of things, I do also see, like, if you get a surprisingly dovish Fed, something that's going to kind of push back on, well, oil prices are kind of temporary. We don't know how long that all goes on. Basically refusing to kind of make a prediction there would be taken as a little bit more dovish. And so I really want to stay open-minded today with the dollar index. A lot of times I go into these meetings with a general consensus, a general thought process beforehand of what I think the Fed might say. But I generally am looking at my stuff. I'm looking at my data here, and I'm saying, inflation was cooler than expected in June, but now July is heating up. At the same time, non-farm payroll was soft, but unemployment rate's still at a relatively low level. So I have this, kind of tug and pull, this back and forth here when it comes to my expectations for the Fed chair today. Dollar index has also been trending higher for a little while. And so I look at this and I think, I'm going to stay open-minded today, because a lot of times, like I said, I go into a Fed meeting with a predisposition, an opinion, a bias. Today, kind of going into it a little bit open-minded. Chris, what are your thoughts on that? Do you have a stronger take than I do? I know my take is not very exciting. It's not exciting to get up and say, hey, I'm going to keep an open mind here. But what do you think? You're muted, Chris.
Everything showed more expensive premiums today. So like the cost of like market mapping this morning was dramatically more expensive than what I traditionally see in the mornings. Like, the expected move today, I'm pulling 60 points. So this from open to close, like we did, I'm looking for markets to kind of stay within this box for the day. We did test the bottom side, and I saw a reaction there, so it wasn't a huge surprise. We also tested that like VIX calculation that I did around 1.2%, and we hit like 1.17. So, dude, interestingly enough, this is just some option structure, but I did a butterfly spread down here in this yellow box, and a butterfly spread versus a broken wing structure. So a broken wing, usually you can take in for a credit or a very small debit. Today it was the exact same price. I've not seen that like in a long time. So I decided just to do the butterfly spread, because that way I have no risk. I have like small risk the entire way, whether it's up or down. So anyway, this morning when we came into live trading, it's like, okay, there's a pretty big call wall around 7,500, and there's a pretty big put wall around 7,300. So for short-term trading, like that to me was like the big positioning of like, okay, we could see the market go to 75. We could see the market go to 73. To get there, either one of them is an outsized move. And you can see on this chart, like if we get to 75, we are beyond that expected move, and we'd be well beyond that expected move. Sure. I think the market is cautious going to this Fed meeting. I think the market is sensitive to this Fed meeting. But in typical FOMC fashion, if they come out with a pause, there's 30 minutes of probably price going up, maybe. because we just sold off this morning. So price kind of neutralizes. And then we have Warsh that comes in and says, we want price stability, our battles against inflation. We recognize what bond yields are doing, blah, 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 blah. And he just sounds, again, like very hawkish. So we could go, I don't know. I think there's a lot riding on this new Fed. I think that he bought himself time with the task force talk that's out to like, December. But the markets are trying to sniff out like, what is this Fed actually going to do in the bond market? The yields are going much, much higher. And I think it just backs the Fed into a corner where they have to at least at the very minimum keep talking hawkish. So
Sure.
I think that is at least going to put in some short-term pain for the market. I just don't know if it's going to be all today because if you saw this earlier, it's like you have the Fed today, and then right after today's close, you have Mag 7. So you have Meta, Microsoft today after close. I don't expect them to have terrible earnings unless they have a similar print to Google. Which what did Google do? They announced that they had the first negative cash flow in over 20 years. And the market punished them for it. But this week, what's Google doing? It's coming back and filling that gap.
Right.
So I mean, it's limited like pain on a good earnings report. But yeah, it's down a little bit. It just bounced right off a technical level. So I could see the other Mag 7s this week doing the same thing. And then meanwhile, Apple has asserted itself as now, number one company in the world. We're over $5 trillion over Nvidia. I do have a trade on Apple. I think it's all the way up here towards like the 370 zone. I'm looking for like a broken wing butterfly structure I'm going to take a short through like the end of August.
Okay.
But it's only going to cost me, if I get filled on the trade, it's a $250 risk for up to $12.50 a profit. So
I like that.
Very much in my favor if I'm right.
Yeah, I like it. It's the counter trade to the Apple run up here.
Yep. So
fair enough.
So to answer your question, like long story short is markets are clearly anticipating some like high direction, high volatility today, but with the likely pause and still a pause and even a pause through, this month and all of August. Yes, there's going to be a Jackson Hole with the Fed chair. So Warsh will be at Jackson Hole. Then we have the big decision in September. I don't know. I feel like with Warsh's way, it's like more is less.
Sure.
Right.
Yeah.
I guess like more is not good. Like he doesn't want to keep giving all this information to the market when he's like, need less from us. We don't want to be as transparent. We want to have, 1 minute dot plots, or we want to have smaller press conferences. We don't care about telling you exactly what we're going to do. Let's have the task force decide that. And so you pretty much put this blackout window of 6 months before the Fed comes out with like this new reform,
Yeah. Really interesting. I mean, it's going to be the less guidance, right? Adds like another layer of potential market volatility to some extent. I want to throw this out there too. I'm just looking at, you mentioned put call walls. I wanted to play around, throw it on my chart as well here. For the traders out there who are not necessarily options guys or girls, this is still useful information. Understanding where, the options market is kind of setting the bets here today is very intriguing. We're taking a look at SPY. I just punched in the August 21st expiration. That's the next major monthly. SPY is what we're considering here. And we had a huge call and put wall. Call wall, a little interesting there, a little softer on that side, but they're huge put wall down there at the 730 strike price. So that's going to be right here. That's just below today's low, Chris. We'll see if that kind of acts as support. We can also see just from a technical analysis perspective, I mean, that's a huge obvious area of support, the bottom end of the recent range. So, if you're playing the nothing ever happens approach, which is kind of option selling, territory, you're kind of thinking, okay, even if we go higher or lower, the market is thinking we're going to have a huge move one way or the other, but the market maker is kind of betting that we'll probably stay in this range.
Yep.
So I think that's most of the time going to be the scenario that you kind of get big moves, but they'll probably kind of settle out within this range. So kind of an interesting take. What I would say would be most significant if you're watching S&P 500 would obviously be a break back towards the top end of this range. If you can get back above that kind of breaks something in the system here, and vice versa to the downside. If you break these lows, then I think that you kind of have the gamma squeeze next kind of run to the next major put call ratio level or a put call wall level. So you start to get into into the scenario where we look fine here unless you start breaking through those lows, in which case I think you could have kind of a further flush. But I think, you know, Chris, we're all here for obviously the FOMC meeting, but I think you touched on it there a second ago with arguably just as, if not more important today, is Meta earnings, as well as Microsoft. I mean, Meta is just a big one because they're such a big spender. They've also been kind of entering into the sell side of compute stuff. So there's going to be a lot of potential energy with that corporate earning taking place just after the bell here today. Chris, I also sold some puts on Robinhood, threw them way out there. I like the stock the long term. So I threw out the, I think I did the 70 strike price puts out 52 days. So I think it's an October strike price. So, or October expiration, but pretty decent volatility there in terms of Robinhood, and we'll see where that goes. I also played Google. That ended up doing okay because I sold those actually after earnings, so that ended up just fine. But we'll see. Again, you can kind of see how sensitive this market is as we go into earnings this evening. Here's Google, right? Remarkable numbers, but the increased CapEx spending expectations were not favorable to the market. The market did not like that. And so, you know, we've kind of seen this story playing out recently where, and I think it's broadening, Chris. I think that software story that we've talked about is broadening, where you have all these companies who are not doing nearly the spending of, you know, AI stuff actually benefiting. Like here's IGV doing just fine today, in a day where you have the mags down, you have you know, the Qs down, semiconductors down. So kind of an interesting shift in nature. I was also looking at this stock. This is semiconductors, software versus semis. This is IGV/SMH. Punch that into your trading view if you want. And you can kind of see here that we've had a little bit of a shift in nature here recently, where maybe software has a little bit more kind of legs to it here recently.
Yeah, well, I think also software has companies that make money. And yes, they are. I mean, that was the saying that everyone used in Wall Street was throw the baby out with the bathwater. IGV, anything that it touches was just like the SaaS again. AI is coming for everyone. It's gonna. I mean, I get the disruption, but here we are with you know, chips looking, you know, way more difficult to say. Honestly, in your opinion on chips and stuff, Nick, I mean, SMH, like, are you still bullish on it? Do you think that we wipe out like the entire move from like March's low to? I mean, do we take the entire move out, or do we have a, you know, coming bounce where I think we talked about this? If we come down to test the 200-day moving average and we finish bullish, I'm probably going to take a stab at that with a stop loss right there, or trade something on options and get like synthetic, but have a very tight stop. If I get a bid, it's like, even if this is low to high, and then we start doing indecision, or we start doing something like this, where it's like just messy, choppy. I'm just looking to see like maybe this like 50 to 61% fib zone plus the 200-day moving average. To me, that's a pretty good technical alignment to have a chance to get long and just do something in maybe like a, you know, 2 to 4 week window.
Yeah, I think I'm the same way. When it comes to semis versus software, for me, you don't necessarily have to be long and a long one and not even touching the other. Right. But for me, with software, they've been from like an investor, from a longer term perspective, software has felt like an easier you know, place to be buying stuff for me. But with semis coming down, I'm also a fan of semiconductors. I just feel like, or just historically, I don't like to buy stuff when they're just beloved by everyone and there's this invincible trade. So yes, semiconductors, to me, I've got the simple moving average here, the 200 simple. You know, that would be a pullback of 33%. So to me, you know, if semis have more room to the downside, 12, 13% lower from here, yeah, I think that the risk reward to picking some up looks attractive in my personal opinion. I don't necessarily think that's a, you know, bottom is in, it's going to scream right back higher from there. But I would take that as a risk reward based bet. You know, is the AI trade just completely dead? If so, obviously that's going to be a bad buy. But if not so much, then it's probably going to look like a fantastic longer term buy. So of course, nobody knows the answer with certainty as we speak about it. But my opinion is the risk reward there is pretty worth it. So I'd probably take a stab if we saw that SMH. I think I would pick SMH over something like DRAM. I like the idea of the semiconductors more so than I do the the specific memory chip, because memory specifically is even more volatile than semis, right? Because you're talking about a component to the overall semiconductor world, which could be, even more contested. But yeah, and the question, Chris, would be, would you rather take a pick at some individuals like an NVIDIA, which is, sitting, by the way, at the 200-day moving average as we speak, or would you rather just go with something like SMH or SOXX or something like that?
Well, for right now, I do have trades in both.
Okay. Okay.
So NVIDIA, I'm playing down here to the March lows. So like the 160 area, 150 area. I have some yellow box down here with all my ratio spreads, previous resistance at 150. So I have some NVIDIA. I know I took some profit earlier. Let me just double check this all here. So I have SOXX. I've got ratio spreads. I've got SMH. SMH is here. So SMH ratio spreads, SOXX ratio spreads. NVIDIA is done. So I closed out my NVIDIA trades in June. So that means I kind of like NVIDIA. I think I'm going to look at this trade right now. I know we have the Fed stuff in 10 minutes, but let's look at like this 150 zone, dude. I'll look at this 150 zone on NVDA. So NVIDIA, let's go out to, I like December, January flows. These are pretty frothy. Yeah, dude, I like the January. Let's see what we get here. So 150 by 140. Not too bad. Build this out. It's $100 there. This wasn't too bad. So a 10 wide profit trap with a $2 credit. Ownership would be 125. If I take ownership of NVIDIA, it's 125. Let me make sure this looks good fundamentally. So 125 allows me to absorb about a 47% correction in NVIDIA. I think the markets would have bigger problems than NVIDIA if NVIDIA is down 47%, don't you?
I would think so.
So NVIDIA from fundamental standpoint, pretty solid. Earnings. I mean, what's funny is people now are like, NVIDIA is actually cheaper than it was a year ago because of earnings and whatnot. And, fair market value is around 230. So I like the trade. I'm going to take this bad boy. Let's go 145 by 135. This is out to January. So I'm going out to the end of the year with a little bit of flows into the January expiration. But give me, let's see if we can get 205 in this thing. I'll go here for a couple contracts. All right. So let's do ratio spread for 205. I'm going to try to find my fill price first, and then I'll put it in for the pulver alerts. But let's see what this does. 205 not filling. Mid price is 202. This is super liquid, so it shouldn't be a couple pennies. Yeah, I got filled at 202.
There you go.
All right, so I'm filled at 202. I'm doing a 145 by 135. I'll build it out and show you what it looks like. Let's go to here. Get this out of the way. All right, let's go to NVIDIA. And that was a January expiration. And I did the 145, 135. So 145, 135, buy, sell. There it is. All right, so this is the trade. If I take this all the way to expiration, as long as NVIDIA is above 145, I'm in pretty good shape. I have a profit trap in here that gives me an extra 20 points of buffer. So my break-even price is 123. So as long as NVIDIA is above 123 by January's expiration, I'll keep that $2 credit. There's no upside risk. If the price is just choppy and sideways, there's no sideways risk. I can absorb about a 40% correction in the stock. I think that's pretty conservative. So I'm not saying I want to see some NVIDIA drop 40%. I'm saying that I'm just trying to stay out of the way and still generate that income pretty conservatively and safely. But that's it. So time-wise, let's say that NVIDIA hits all-time highs, Nick. Like everything's great. AI trade is back on. Let's say we hit all-time highs. Well, if I can hold this trade through, let's say the end of October, okay, if we're up above current prices or back into the 200s, I'm probably receiving most of that profit up front. Like I don't have to sit on this trade for 3 more months when I can just get the profit if we make all-time highs. It's this. If we go sideways or we break to the downside, you can see that I do have some risk in the trade. So if things get really nasty, really gnarly, I do have some volatility risk, but I know that my actual break-even's all the way down here to 123. So if you have a naked put out there or a cash secured put, there is undefined risk to that strategy. So you just want to know, like, where is the exact line in the sand that I need to talk about it? Yeah. Like
Sure.
where I need to defend it.
Yeah,
Okay.
I like it. It's a conservative way to kind of stay modestly bullish overall on what's going on in semis. Chris, I just want to take a look at a couple things here. We've got just a few minutes to go. Just a heads up, guys. So we are going to get the decision, and usually it's sort of a nothing in terms of the release, but today the release is actually pretty meaningful because there is down to the wire here some uncertainty as to whether or not the Federal Reserve today will hold interest rates steady or actually choose to hike them. So in the next few minutes, we are likely to see some volatility here on that decision being released for the US dollar, for gold, for stocks. Pretty much everything is going to move off of this. And let's just do a quick refresher. Obviously, if you are watching the DXY today as kind of your proxy for gold, for currency pairs, etc., if you get a hike, it is a good chance that the dollar index is going to take a run through these highs. And if not, then obviously it is likely to kind of come down a little bit. The bigger surprise move would be the event that we get some sort of hike from the Federal Reserve today. A 25 basis point hike is on the table possibly, but it is the less likely scenario. So whenever you have the less likely scenario, obviously the move, if that less likely scenario takes place, if it actualizes, then the move in markets will be much more drastic. The other side of that is that if you do get a rate hike today, the narrative that comes with it is very, very important. So if they come out and they say it's sort of a taking some risk off the table rate hike to kind of just keep inflation on check, and also, the Fed wants to appear a bit hawkish to kind of talk down inflation. If that's the narrative today, you really want to, the market will be trying to sniff out whether or not there will be more hikes from this, or how close to another decision for another hike the Fed potentially is. Remember, markets are always forward looking. They are looking today at not just whether or not we hike or hold today, which is, by the way, a volatile aspect of the day, why it's probably one of the most heavily anticipated Fed meetings that we have had in probably the multiple last few years. But simultaneously, the market's trying to figure out, where are we going from here? Is it a one and done hike, or is it a stay steady, hold steady, wait for more data, and don't, because there's a fair argument to be made that we should potentially hike rates maybe once or twice this year. It's understandable why that's the discussion. You have inflation well above the 2% target, and the jobs market seems to be holding up relatively okay on an overall aggregated basis. My opinion when it comes to this, as I discussed earlier, for people who are just tuning in, my take on this is kind of mixed. I can see the justification for a hike today. I can also see the justification for staying out of the way and waiting a little bit longer. Again, the non-farm payroll number for the month of June was pretty lackluster, but that was just one print in the last several, which have been healthy. Unemployment rate has also remained fairly low at 4.2%. Unemployment claims recently strong. Job openings have recently been strong. So you have some strength in the labor market, but at the same time, you have inflation coming in softer than expected. So that suggests, okay, maybe Fed doesn't need to rush to hike rates. But here's the latest problem. Yields are moving higher as oil prices are spiking once more. We're going to get a taste today as to whether or not the Fed is very quick to react to something like oil prices blowing out, because again, they're up like 30-something% in the month of July. Does that get them to move? We're going to get a little bit of a flavor here of what this Fed, which is fairly new here since Jerome Powell, I mean, it's a lot of the same committee members, but new Fed chair, is how they kind of behave, how they set the narrative, etc. So it is a very potentially volatile moment here that we have coming in just about 2 minutes. Real quick, if you are interested in the tool that I'm using, it's called Edge Finder. We'll drop a link here in the chat. If you're interested in exploring it, speaking to our support team, they can set you up with a copy of access to it. If that's something that you're interested in, they can set you up with a payment plan, etc. Click the link. We'll drop it in the chat here for you to take advantage of that 40% off sale we're doing right now for our summer sale discount. So if you're interested in macro scanners, get yourself a copy while that lasts. Chris, is that fair to say? I mean, usually the release is not a huge market mover, but today it could be.
Yeah, Anything can happen, man. I mean, honestly, even the big surprise to me would be if prices closing well below 7,300 or well above 7,500. Even that is like a 2 times expected move. Like that's pretty extreme as it is. I don't know what would be the catalyst for it outside of maybe, Warsh just says something the market absolutely doesn't love. I don't think that, the committee is convinced that we have to raise rates unanimously. I don't know what's going to be expressed. I don't know what he's going to share in the press conference. I think he's going to toe the line with like price stability, task forces. We're looking into it, blah, blah, blah. I don't think he's going to really even acknowledge Iran or the oil prices stuff. I really don't. I think he's going to maybe comment on how we had a huge improvement in CPI and PPI last month. And if that trend continues, like they'll continue to be a wait and see. It's like, it doesn't make it easy. Like there's a lot to assess with his press conference. I still think it's going to be a pause. It'd be a huge shock if they raise. If we see a surprise hike, that is the first time in 16 years that the Fed Watch tool has been incorrect. And the market probably has an awful reaction in the interim, and maybe a zero DT is blown out. But zero DT is incredibly powerful nowadays, man. Like, I mean, it's 55 to 60% of all option volume is zero dated. And so unless everyone just turns into like negative gamma, buy puts, and just blow this thing to the downside, it's like, it's probably going to have some type of defense. FOMC days usually have a lot of highs and lows and volatility. So I could just see us getting, I mean, let's just say this, dude, knee-jerk reaction. We come down to like 73.40. Maybe we come down and try to kiss the 7,300 handle to really test the waters of that put wall I talked about earlier. Or we come right back up and start around 74.29. And the afternoon is just like, we just drift a little bit up. We drift a little bit down. It's still inside the expected moves, but it tested the low of the day and the high of the day. That's still a volatile day, but it's still within reason of like what was kind of priced in.
And
we've got we got a reaction right now. So
got a little bit of movement here. Dollar index is moving lower here initially. We do have S&P 500, gold moving higher, silver moving higher. So that's going to signal most likely that was just a hold there on the interest rate. The question now becomes, as we saw Marco in the chat say, do we have a hawkish hold or more of a just a very neutral hold, which would be obviously the sort of most ideal case in the eyes of the market. We'll see. But anyways, dollar index is sharply lower here. Gold is moving higher, up 4,080 here. At the same time, S&P 500, more recovery to the upside here now, which was already kind of went from very red on the day to looking a little bit better here. So the surprise hike does not seem to be the narrative. We would probably know if it was.
All right. Well, this is kind of an FOMC feel that we're pretty comfortable with, which is pretty quick knee-jerk reaction. The market just jumped up about 30 points. I would say even if we rally up here, Nick, let's say we rally up to like 74 and change, 74.25, 74.50, that could fade very quickly. So I'm not getting too excited on any one-sided move. Same thing is true. I know you have the workspace up. I think I built one right alongside you, 1 minute macro.
Yep.
So, just to see the knee-jerk reaction, gold is up, oil, nothing, dollar down. This is Dow up. This is Q's up. This is S&P up. So anything on the, headline front, I'm assuming they just paused. Yeah.
Yeah. Almost certainly. Cause it's in terms of the day, you've still got stocks just modestly in the red. And to your point, for listeners, Chris and I have watched these FOMC events for a long time now. And I'll say this, so often you get a move and then it goes the other way. And then, it's very hard to draw a conclusion off of just this move. Although this is a promising start here today. Again, dollar index making a sharp move lower in response to this. And gold really loving the idea that we didn't get that surprise hike. And for good reason, you're getting some moves. Again, market was kind of divided. Like there were a good number of people expecting a potential rate hike today. So not seeing it, market is appeased by that. They're loving the story there of no hike. And now the question is, how is the delivery from Chairman Warsh?
And is this a surprise? Like, no, was it forecasted to be a hike today? And it's not a surprise, dude. It's 65.35. It's a pause. For the market to just absolutely be like, oh, guess what happens in September? Maybe there's a high. So it's just, we're going to deal with more noise. The bigger picture right now is we are still stuck in this ridiculously tight range between about 73.75 now and about 7,600, 75.80. So I mean, this market just refuses to really break and go anywhere. So we have, you know, this recent high, 75.80, and then we tapped those lows today, but I mean, we've had pretty strong support around 73.75 that's now hanging in there. So where are we at today? Do we go back up towards, I mean, there's structure here, 74.50. There's structure at 7,500 for a gap fill. I mean, yeah, it's just noise, man. And meanwhile, individual stocks are, you know, up and down all over the place. It's like, but the indexes just chop around and they're just really noisy. So I'm hoping that we just continue to grind through some of these day-to-day actions and, you know, still get paid in the indexes.
Yeah. Chris, what do you think about gold having obviously a decently positive reaction to this today?
Yep.
Gold's up 1%, silver's up 2.3%. Meanwhile, on a day that oil is up, 7%. So you've still got geopolitical uncertainty. Obviously, gold loving the idea we're not seeing that hike today. Any thoughts on gold? Is this something that I still have personally one trade open on gold? I've still got my short puts open on gold, which are looking perfectly fine on GDX, which is the gold miners ETF.
Okay.
I've just watched this thing go sideways, which has been great because I've been, obviously short premium there. So, what are your thoughts on gold?
I also, so when you and I talked about GDX last time, I did take a trade with you. I built out a ratio spread here. This is a 65 by 61. It's up about 43%. That's fine. I'm going to hang on to a little bit longer. 65 by 61. So I'd own this around, what would that be? 56, like $56.
Yep.
Where's your put at, by the way? I think you were a little bit higher
68,
than me.
68.
Okay. So I would take assignment, much lower. I don't know what the big catalyst is going to be to have gold zoom to the upside, but I do think that what we are likely going to deal with in gold is just a larger accumulation pattern.
Yeah,
that's what I think. I mean, this could be just like this slow bleed to the downside, falling wedge. Then all of a sudden we round out this bottom. I don't know if gold has this mania left in it, but I think that gold does have accumulate, break some structure here, work its way out, and then it's just like a healthy bull market that resumes. If it surprises me to the upside, hooray, we have a another mania driven gold trade. But to me, it's like this was the mania, all the fever pitch that was reached when GLD options were exceeding the SPY. I think that's when we had the top. So I think at this point with leverage and margin, and then they changed margin how many times when it was falling? Like 3 times to make it more expensive. It's like the small pockets would have just gotten abused in the gold and silver futures market. And that's why I think that the deeper pockets are just like, we'll just build this position back up and we'll hold this thing. And this is like an indefinite, 3, 4, 5 year hold. And it's, I mean, at the very least, dude, it's a 50+% upside. I'm happy with that. That's a great move on gold. It's like, I think the expectation of gold's going to, go to 10,000. Cool if it does, but even if it makes 50%, that's still a great trade with a lot less risk than what I'd say is the high flying semiconductor place.
Yeah, and again, my thought process on gold right now is short term. I'm very kind of mixed. Long term, I do like it to the upside, and so that kind of leaves me in the camp of I like the idea of selling cash secured puts and continuing to buy the dip on gold slowly with no leverage, not doing like a 15-minute chart bullish trade with a tight stop, but rather just building out my GDX positions or my GLD positions and letting it sit in my portfolio. So again, I also don't know what the catalyst to get gold to do another run to the upside is. And I also think if you're looking historically, if you know your gold history, it can really range for a while. It can stay doing nothing for a very long period of time. So I kind of find the happy middle ground selling that premium. If I get assigned, great, I build my position. And if I don't, and it chops or goes higher, then I can kind of just collect something for my effort there. So that's, I feel like a perfectly reasonable play for my own style of trading, to kind of just sell those out of the money puts on GDX and wait for better prices if we get them. And if we don't, then so be it. So
yeah. Why can I ask GDX versus GLD? Why is that the preference?
So really, truthfully, I like both. I like the miners, and I like the obviously just the GLD ETF. Here's the truth of it. I don't like to trade. I trade GLD very actively in my portfolio. I don't like to have trades on while I also have options trades on, if that makes sense. Like I'm just long short on GLD a lot of times. So I will just buy GLD in some of my portfolios, but then on like kind of the main portfolio, I'll just to segment my trading activity in the same portfolio. I just like to do the GDX kind of short puts. They also have a lot of implied volatility on them, so I like the kind of the juice there.
Okay. Well, yeah, I mean, GDX also, I mean, from option side, it's like the assignment price is tying up way less capital if it's cash secured put versus margin.
True.
Yeah, I've got plenty. I've got GLD, SLV, GDX. I haven't dabbled a lot in gold futures. I usually save that for when I'm more confident in the trend. So like when gold and silver were heading higher, I was doing just like debit spreads, and gold futures, and just generating those income trades, while also like selling puts and ratio spreads and stuff on the underlying. So I'm look, dude. I mean, let's back up to when gold hit the highs, like the all-time highs, and it was just absolute mania. I am so happy that the market has given us an opportunity to accumulate again, because I'd be pissed if this was like, yep, gold's at 10,000 now, and I like had nothing to show for it outside of taking profit after a 4-year bull market,
And that's the way to think about it, because it's like when it was at those highs, we're sitting there like, dang, I wish I put even more on this, But then once it starts coming down, you're like, well, thank goodness I didn't put more on that, right? It's the same concept. So.
And the same thing goes for, I mean, look, dude, this market made you feel like you had to chase a lot of stuff, and part of me wishes that I chased a little bit more in April, May, because it was such a big run, like V bottoms on the indexes and crazy aggressive runs on the AI play. But it was literally, it's 15 or 20 stocks, man. It wasn't everything. It was like, it was concentrated in essentially what, I mean, kind of jokingly, but it's like what a Donald Trump and Nancy Pelosi portfolio was telling you to buy.
Right.
Buy Intel, buy the crap the government's like, this is a good stock. We're going to reward you for quantum computing. And all these stocks just take off out of nowhere. It's like, when's the last time IBM was relevant? Well, it's now. When was Dell relevant? I mean, none of these were relevant until just recently, and I just think that it was nuts to see like a SanDisk and a Western Digital have the gains that they had for the year to date. That being said, it's like, yes, I was a little salty that I didn't chase more, but at the same time, I'm like, you know what, dude? If this market just grinds for the rest of the year, like, I'll be fine. We'll probably still produce. I'll probably be like high teens, maybe low 20s for the year. That's respectable. Obviously, if we have like a decent chance to get in for more of like a V bottom look again, then I'll probably participate and have more, more alpha beta to show for it. But I'm not aggressive right now, man. I mean, I know we keep saying cautiously bullish, but I think this rotation trade is impressive. It's very hard to be like, this is what's going to run for the rest of the year. It's hard to know that. I think this could be like an absolute chop fest for the next several months. There might be like the broader market pain that gives us into like, the October bottom, like October, November through midterm drama could possibly be another leg higher after some indecision and the market cools off a little bit. I'm still interested in buying the top. I don't think the AI trade goes away. I'd be genuinely nervous if we see, 10-year yields and 30-year yields like significantly higher. If we're like another 50 to 100 basis points higher, I'd be really concerned that this market has little to no upside left, but we're not
I think the market would be too, because if you saw yields making that kind of move, if we continue to see them move higher, I do think that that starts to continue to weigh on the semiconductor trade, and all the data center build outs and just everything leveraged starts to get called into question on that front. Also, just going to read some headlines really quick from the rate statement. Inflation remains elevated relative to the 2% target goal, in part reflecting supply shocks in certain sectors, including energy. The Fed vote in favor of policy was 9-3, with Feds Hammack, Kashkari, and Logan dissenting in favor of a 25 basis point increase. So there were some votes for an increase, but clearly not enough. And this also is moving, let's see, Fed swaps no longer fully price in a September rate hike. So a little bit more dovish outcome here than what was expected. Obviously, that is what we're seeing, or why we are seeing a sharp rally in things like gold and in stocks. as well as a little bit of a give back here on the 2-year, but not a crazy move here, Chris. Like, we're not seeing yields like absolutely plummeting lower. We are still seeing kind of, all right, so we're, as you pointed out, market kind of slightly leaned in favor. Well, it did lean in favor of a hold, and we got the hold. We are still on watch for the rest of the year.
Yep. And as they say, the government keeps spending money until the bond market takes away the keys. So the growth continues to figure out, is this the growth story? Is this AI? Is this momentum? The one ticker I have also been watching, in addition to, I mentioned this probably the last couple of months since we topped out here in June. SMH, something to watch as far as momentum. MTUM. Look at this bad boy. So value, rotation into value. I mean, look at Coca-Cola. Coca-Cola's at $90. Like, we had a huge move on Coca-Cola. KHC, Kraft Heinz. We've had some defensive plays that have done really well. I mean, momentum down 18%. It's like, look, I don't know, how much I want to like participate in this, but it's like, dude, if we see like a meat grinder market, this might be something entertaining to, like, maybe we get long here, but this is my trade. I did a ratio spread on MTUM. I'd be willing to own this thing, and that's if like all the momentum goes away, and I'll start from scratch, because this will rotate. Like the shares that go into MTUM rotate on like a, I don't even know what it is, like top 5 or top 10 momentum based stocks and IV rank stuff. It's like they rotate quite aggressively. But I think that this momentum resumes in like mid-October, late October, November. I just don't think we have much momentum to the upside without like a pullback. We need look, the market needs that reflexive rally, right? Our best runs to the upside have been because of a V bottom. And so this look is very tough for the market to be like ripping to the upside, when instead, and we've talked about, this is the tough trade to me. The tough trade is that we don't have a blistering upside. We just have like this, just slow and steady. And it's every 1 or 2%. It's bought, but it's just like, good God, why won't you can't get any momentum out of this, right? That's a tough trade. So a 10% correction that rallies, a 10% correction that finds a bottom, there's a lot more to position for, and actually like quickly benefit from that V bottom. But yeah, the hard like slow rally to the upside is challenging.
The MTUM ETF is kind of interesting, because for people who don't know what this is, it's a factor ETF. So it's an ETF that has a strategy kind of built into it. You buy this ETF and it kind of automates a component. It's basically buying the winners, right? Whatever are doing well, it's typically going to find its way on I don't know how often it rebalances, maybe quarterly or monthly, but it will rebalance and add winning stocks into the mix. But obviously, that strategy works at times, but it also works really poorly at other times. So like when stocks are, ripping to the upside, and you have like winners just keep winning, and, you look at something like, for example, maybe like an NVIDIA, when it's been doing phenomenal, like it finds its way into the momentum ETF alongside a bunch of others that are doing something like that. And sometimes that strategy is great. Other times it buys it right here and the stock falls apart. So, when there's follow through in markets, that ETF is really nice to kind of hold on to winners. There's also the quality ETF, which is another one. It's kind of interesting to keep an eye on, which has been holding up really well here. Then there's like value. There's all sorts of different
check SCHD. That's basically like a dividend stock.
Yep.
I mean, it's like RSP. It's up to all-time highs.
Yep. Really solid. So this is, if you're a dividend person, you pay to hold on to stocks. This is an ETF that tracks a bunch of really consistent payers, reliable companies. And so you have all different types of choices, and everything has pros and cons. Because I tell you what, here's the big con with SCHD, is that when you have tech ripping and you have everything doing really well, SCHD can go nowhere and make no gains. But then there's times like now where you have tech's getting killed, and here's your value quality companies paying their dividends, doing just fine, and trending to the upside. So just goes to show, even buy and hold stuff, there's times to think about various types of stocks, various types of markets. And again, rotating back to like commodities, we've talked a lot about commodities this year. If you see inflation staying sticky, but the economies of the world continuing to chug along, that dynamic kind of favors commodities over the longer stretch. So there's all sorts of different ways to be thinking about this. Just an update, Chris, here on our the 30 minutes here between are always interesting, between the release of that data point as well as the press conference. We've got the press conference in 12 minutes. Guys, don't go anywhere because we will be listening in on what Fed Chair Warsh has to say. We'll pull that up on the screen and go through that. Listen in. Stocks here they initially popped very sharply on this rate hold. The market is now seeing a little bit of give back here. The question now becomes, what do we hear from Kevin Warsh? I'm curious what you guys in the chat think. Do you think Kevin Warsh today will come out dovish or more hawkish? Drop a comment in the chat. Let us know what you think about today's commentary. Do you think he'll kind of reiterate we need to win on inflation, we need to get more tough on inflation, hold rates, maybe hike them? Is there some sort of that narrative, or is it going to be super vague and maybe leaning more dovish? I'm going to say that I think if we're just going off of what he has been saying and what the bond market has been generally doing, I think consensus is, generally speaking, he's going to stay hard on inflation. The question is, will he do stuff, that really needs to, or like get aggressive on that? I would say he leans a little bit hawkish today, but we'll see. What do you think, Chris?
Well, I mean, if the bond market's really the test that he's dealing with right now, I'd say you want to be as hawkish as possible and not have to you don't want to raise rates, but you got to talk I don't think this message is clear enough. If the message is, we're going to get to 2% inflation, dude, we've heard that crap for 6 years.
Right.
What
are we going to do to get
exactly there? It's like, how do we get there? Raise rates to 5.5%. Maybe we'll get there. It's like, that's not going to be good for anything equities wise. So, it's like just to talk it, like jawboning, I don't think is going to work in this case with the yields being where they are. So you can lean hawkish, but it's just not going to get the job done.
Do you think there's a possibility that the rise in oil price could be a justification for more hawkishness? Like if you're thinking, I don't want to, like if you have to raise rates, it might be easiest to do so pointing to structurally higher oil prices, we've got inflation that's going to take some time to work through. We're going to take out some insurance, hike rates to kind of keep a check on inflation.
Well, I think that points the finger to, what are we doing in Iran? Like that points the finger at the government for what are we doing? Why is oil price up? Because of a conflict in Iran. So it's like, I don't think he's going to point the finger there. I think that the AI trade, honestly, like AI, compute power, that's made things more expensive.
Sure.
Like the growth we have is linked to building out data centers and everything that's, buying up all the storage, demand's insatiable. Dude, it's made everything more expensive. I mean, if video game console prices going up or buying a new laptop or PC is going up, that right now is like an inflationary pressure. It's going to trickle into like cars and everything, like car wise, has way more computer pieces and software pieces, EVs. I mean, the cost of a car, the cost of insurance, the cost of fixing cars, like all that stuff is like, that's an inflationary pressure. So I think that to blame oil on top of really like AI pressure, I think it's misplaced. I think that we have sticky inflation because of two main things. Oil prices have gone up. We need to acknowledge that is a, maybe it's a one-time shock, but we're still sticky around $90. And then right now it's like the AI deflation. I don't know. I mean, I don't think it's acknowledged that we have inflation is not going away. And I think what really makes me nervous is deflation oftentimes comes with a correction in the market and a spike in unemployment. This is another thing that I would say could probably be suppressed data-wise, is we're not going to see are we going to see non-farm payroll jump from or our unemployment rate jump from 4.3% to 4.8? No, it's probably going to be 1/10 at a time, frog in the boiling pot. And eventually we're going to have a 5% unemployment rate. And people are like, well, historically this is pretty low, but this is a big increase in unemployment. Dude, tech has been shaving jobs since 2022.
Right.
They haven't come back, So, then maybe that's not right now, but I think there is going to be some labor market pressure in the next maybe 1 to 2 years, where it's like, dude, if AI is this amazing and this deflationary, people are getting sacrificed to build out more stuff to make AI more productive and profitable, right? Like, I mean, again, as an entrepreneur, start a business. There's no better time to start a business and work with AI in some capacity. I'm sure it makes people more productive, do things you can't do, but it's not easy to do that. But I feel like, you know, the next 5 or 10 years for a labor market of like, I'm just going to go, you know, get a job, have a W-2 and enjoy everything and work until I die. It's like, that's not how it works now. It's like right now we have people that are just surviving and thriving on side hustles, you know, 1099s, and you got 5 of them, 10 of them. It's like, that pays the bills. It's just not a traditional, it's not a traditional W-2 when you're working for the man and build up for retirement. It's like, you're just trying to freaking grind. And I don't know. We have a supportive like gig economy, but I don't think that this is another thing. Like, I don't know if the task force will talk about this for the Fed, is like, what's our labor data going to give us? BLS data, I feel like, is not even trusted now. I mean, we had a shutdown last fall that disrupted all this stuff. So, I mean, I do think that unemployment rates could start to trickle higher. And so we say AI is like the best thing that's ever happened, but it's like, dude, there's going to be casualties along the way. And I think it's going to be a huge adjustment for a lot of people.
Yeah. Chris, we've got some interesting moves taking place here as we speak. We've got, look at this. The Dow Jones is just, I don't actually know what about this one is so exceptionally weak today, but look at the Dow down 1.6% today. You know, Nasdaq has given back some of those initial gains here that we saw, but the Dow Jones is like almost back down to the lows. Really interesting just to see that kind of relative underperformance. You've got, meanwhile, the S&P 500 down the least of the majors, and the Russell kind of also really jumping and dropping here sharply. A lot of volatility in there. Gold here also giving back a little bit of those gains. But guys, we are just about 5 minutes away from listening in to what Fed Chair Warsh has to say on the topics of future projections or what may come for the Federal Reserve in the future. He will probably keep his cards close to his chest. That has been his kind of approach here recently. But I'm sure reporters will try and dig in on the decision today, as well as how close, you know, what were the conversations like behind closed doors. Obviously, we had some committee members today that dissented in favor of wanting to hike rates. So you do have a narrative within the Fed that is on the theory, on the side of, hey, it's you know, it's reasonable to move interest rates higher. So we'll see. It's definitely an interesting couple of months ahead of us as we start to go into the second half here of 2026 as to whether or not we're going to get a rate hike and really the delivery that comes with it. Jackson Hole Symposium, big one next month. That will be a very, very important market moving event. And just as we watch the clock here, guys, remember that also in about an hour and a half to 2 hours, we are getting significant potential volatility from Meta and Microsoft reporting earnings after the bell. So you've got a ginormous day on watch here. Lots of volatility still baked in. You got the VIX sitting around 18.7. Oil's higher today. I mean, there's a lot of pent up energy in this market here as we go into this press conference as well as earnings after the bell. I'm kind of on watch on stuff. I'm really just interested to see the commentary from Kevin Warsh, because again, right now we're starting to see a little softness on the dollar index. But we are now, the question mark is, do we get the hawkish hold? We hold interest rates with the open-mindedness of raising them if needed. You could still see dollar strength today if that is kind of the case. And at least in the eyes of the stock market, a little bit of caution going into the press conference here.
Agree. What do we have for real-time inflation, by the way? So not BLS stuff, not our CPI, PPI, because I know that was a big improvement from the last month. But I'm seeing trueflation. I mean, we were at like 1.8. Now we're at 2.06. Like it's still, you know, it's sticky. It's elevated. I wonder if I feel like Warsh is going to come in. This is going to be an interesting test. If he says task force, like the whole time, it just means he's trying to like get the spotlight off of today's like press conference and today's decision and just look out 6 months and the Fed will figure crap out behind the scenes. Like that's kind of what he's saying. And yes, we'll have another round of CPI and PPI. We'll see what prices do. August is like the whole world's on vacation for August. Usually it's the last month of summer. Jackson Hole comes in, you got Nvidia earnings, but like, this week with Mag 7, next week with another 1,000 companies reported earnings. This is kind of the sweet spot for, if you like to trade earnings, this is where things are going to be moving and shaking. And because the market's been so suppressed with volatility, I feel like any catalyst is going to drive some price action. So I think that trading some earnings actually could be a good way to play, the near term for some income trades. But yeah, it's just going to be a really wild, like 60-day window, because you take, ongoing stuff in the Middle East, you take, earnings, which I would guess for the most part is going to be decent. My concern is that, okay, so last quarter's earnings on, the Microns and the SanDisks and all, like, they were stellar, could do no wrong. It was already ripping to the upside and continue to rip and even exceeded the priced in moves. Now that we pulled back 20, 30, 40% on some of those individual stocks, then they have earnings. I mean, I would think the earnings are going to be amazing because they're still up 100% for the year, but is there a bid there? Or is it like, sell AI and just move into more rotational stuff, more defensive, more rotation? That's another thing for price action I'm watching very carefully these next like 30 to 60 days.
Yeah, we'll definitely be interested to see. I mean, the earnings today, I think the market is almost pretty much like sure that the Meta and Microsoft earnings will be good. It's really, to me, it's how do they react to the CapEx stuff? Because that was what slammed Google.
Yes.
Is not, I mean, Google had phenomenal numbers, like really, really good numbers. Didn't matter. The stock was sold off hard because people were like, yeah, you're going to spend a ton of money. And that changes the risk profile on these Mag 7 companies. That's what we've talked about over and over. These companies were free cash flow monsters where they just had a ton of excess cash to sit on, and investors loved that cushion. To now you have, Meta and Google and Microsoft dipping heavy into their free cash flow, and some even going into the debt market. So borrowing money in order to continue to invest and build out in the AI story. Now, there's two ways to look at that. And I've got to pull up the press conference here. Hold on, give me 1 second. But,
okay, why are you doing that? I think Oracle is probably the poster child to see whether this is a make or break on CapEx. Oracle is the first one to issue like the heavy amounts of debt, and their stock sucks. So if everything starts to look like an Oracle, then we've got a lot of problems. But we'll see. The other companies are obviously better positioned and way more relevant than Oracle. I feel like they could. I think Mag 7s could also pivot hard. They could pivot into like what a Meta is trying to do, which is we'll sell our compute. We've got storage. We got this. We'll build our own chips. Make it more competitive out there, and also put more supply in the market for the compute demand. That could help. So anyway, all right, he's at the podium.
Yep. Chris, can you hear this?
Good day.
Yep, we're good.
Okay.
My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman. And I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly, but the bond market's saying many of those same things. And that's why we're seeing a tightening both in nominals and in reals. Even while at some level, we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterize the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. it was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately, there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much, not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead. But I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. It suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate, inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a three-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. But I wouldn't say it's in isolation. I tried to describe in my remarks today the point that I made into the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no, we will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we've made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. What we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months, we're going to refine that view and have a better judgment. And we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically in your mind would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause. They reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods. They matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, which is I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple of weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Temeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable, such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools and making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order. But really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in around AI, it's making that calculation a little harder to judge. But in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us. They weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions. And if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast. We don't want your dot. We just want your reaction function. Part of me hears what we really want is your forecast. What we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode. We were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all that information. So I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit.
Paul Weissman. There's a mic coming.
Thank you. When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number. We're sticking with it. Who knows, come after next January, what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty. So the decision we made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it. But I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced. And over the coming months, I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, I won't let you, you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks, but we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well and ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by, these outside groups. My theory of the case in establishing the task forces were to pick people with extraordinary talent, depth of expertise, and a divergence of views inside every committee, so they too can have a family fight. This is not outsourcing to people that aren't known and haven't been vetted. This is seeing whether new ideas can catalyze a broader, better, more informed discussion inside the room. And I'm very confident that we're going to be able to do that. I am impressed by the credentials of these 15 people. And full disclosure, I've known almost all of them for a very long time. And I think they're going to give their best views on the subject. But ultimately, these are decisions we're going to make, and we're accountable to our oversight committees and to the remit Congress gave us to deliver.
Hi, Ann Saphir with Reuters. Nice to see you again. So I need a little help here too. You've said repeatedly you have no tolerance for inflation, and yet we are seeing above target inflation repeatedly for 5 years and through your term so far. And sure, you have no magic wand, but you have not taken action. You just gave us a little peek at your reaction function as well. You said that if underlying inflation is rising, that you would tend to think that you might need to tighten. And with the exception of the most recent inflation print, that is what we've been seeing. So could you explain what you mean by no tolerance for inflation and what you plan to do about it?
Sure. So, Ann, I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already. This is not an excuse. This is a fact. This FOMC, this board has been in business for 8.5 weeks. The patience, the impatience that households and businesses feel have been going on for 63 months. We are on the job. We will deliver. We are focused like a laser on making sure we can do it. But the suggestion that we're going to be able to do it with our magic wand is one I want to disabuse you and everyone else of. But the discussion in the last 2 days give me more confidence even than I had 8.5 weeks ago. This team that we have at the FOMC, the support that we have from board staff, and the new hard questions we're asking, we need to resolve those. And as we resolve those questions, get smarter on those, we're going to deliver on the remit. You don't have to take my word for it. If you look broadly at market prices, they are certainly not saying all clear, but they are working in concert to keep us on our toes. And they have tightened financial conditions in this intra-meeting period. And that has given us, that has provided us some comfort that we've got the ability and capability to deliver.
And is your read or your, I guess, faith in markets' ability to sort of make a judgment and then you to take signal from that judgment, is that, how does that affect you when you come up on the September meeting and markets are seeing a near 100% chance of a rate hike as they see now? How does that feed into your decision making and your thinking?
So we're not going to be constrained by market prices. We're not going to be constrained or take verbatim from what the market's doing. But I think it's useful and to understand that markets can be a very good source of information, not a determinative source, not a perfect source. But if we're trying to land the plane and deliver 2% inflation, and we take a very useful source of information and we get it all fogged up by giving it our own forecasts, by providing rolling commentary, I can assure you that we're going to have less information, less ability to land the plane successfully and deliver price stability. We're just trying to make sure that that source of information is as direct and unfiltered as possible. It isn't to the exclusion of data sources and opinions and other surveys. But if you're hearing from me, we wanted to make sure we were getting a better source of information. I think in a relatively short time we are.
We'll go to Brian Chung for the last question.
Hi there, Chairman Warsh. Brian Chung with NBC News. So you said you'd be open to having press conferences when there's news to make. So today, no change to rates, no forward guidance. For the average household, I guess, what was the news today?
So apparently it was news that I had a press conference. Let me just see if I can offer some clarity on that. Between now and year end, my predecessors and the Federal Reserve committed to press conferences this year. I'm committing to press conferences this year. That might be news to the people in this room and of no particular interest to your viewers and your readers back at home. What I can offer as assurance is that the Fed's on the case, that this Fed chairman feels better about this board and this committee's ability to deliver than I did when I showed up here on the first day. And I showed up pretty confident. I've been heartened by the reception that I received. No doubt in some of your commentaries today, you'll talk about a divided Federal Reserve. Well, that's not the feeling I felt the last couple of days and the couple of days before it. What I felt was a group of professionals, all with different perspectives, different views, different judgments, but eager to roll up their sleeves and have a family fight, and eager to reform the way in which the Fed does policy, a keenness and open-mindedness and curiosity about that. So we have a far better chance to deliver on the remit that Congress gave us. And so I want to leave you with the optimism of a new central banker that we're committed as ever to deliver and to offer an assurance we will. Thank you all very much.
All right, guys. So we had the final kind of words there from Kevin Warsh, and it was mostly an uneventful Fed meeting. However, there were a couple takeaways that I thought were very, very interesting. Notably, you know, the press pressed him several times on the concept of, okay, what are you actually going to be doing to combat this inflation? I thought it was interesting that he kind of suggested that the market would do his bidding for him. That was kind of the concept of, you know, he pointed out the markets, specifically the bond market, the dollar, et cetera, kind of already making the move higher and sort of front running what the Fed was likely to do next. So very interesting stuff. I'm going to be filming a video kind of outlining my thoughts and notes from this. So stay tuned on that. I would encourage you to subscribe to the channel if you are new. Don't miss that video that should be coming out shortly. And I just want to also invite you, if you are not already inside of our free Discord or our free Telegram channel, join us there for updates where we will be publishing overviews, explanations, breakdowns of what took place today and how it might impact markets next. Got a link right below my camera here. You could scan the QR code. Alternatively, if you prefer Telegram, join us in there. We'll be posting trade ideas and setups in the following hours on this subject. Thank you guys very much for tuning in to today's live stream. I hope you got a lot out of it, and we will see you on the next one. See you guys. Have you ever wondered how you could find more trades like this gold runner, or the S&P 500 breaking out to all-time highs, or this sell-off in dollar Swiss franc, which was a clean short opportunity? Well, all of these charts shared one major thing in common. They all had powerful macro fundamental catalysts driving price decisively in one direction, presenting a really strong trading opportunity. Hi, my name is Nick. I'm a 10-year trading veteran and the founder of A1 Trading, where we build market scanning software that help traders to track macro fundamentals, crowd sentiment, and the commitment of traders' data to best understand where institutions are moving their money. Our tools automate everything from studying jobs market data, inflation statistics, and economic growth metrics, bringing it all together into a scorecard or rubric that helps to spot better potential trading opportunities through our insights offered by the tools. So if you're looking to access our tools, stream viewers get extra discounts, and we're currently offering payment plans as an option for those who would like to split up the cost of our tools into a couple monthly payments. Alternatively, we also offer a free Edge Finder tutorial course, as well as fundamental macro course that can help you to learn the concepts behind the tools. Scan this QR code that you see on the screen right now to be connected with a real person from our support team. We have helped thousands of traders level up their trading through insights, dashboards, and automation. And we are passionate about this subject because having the right tools that hedge funds and proprietary firms keep locked in key is a powerful game changer for the average everyday retail trader. To explore our products, payment plans, and just to find out more and speak to a real person about this, scan the QR code that you see on your screen right now. Alternatively, the link can be found in the live stream chat or in the description of the live stream. On our website, you can find a collection of both free and premium trading tools that our team has put together to help traders take their trading to the next level. Well, you might be wondering, how can your tools help me? Well, whether you're a swing trader or a day trader, our tools are meant to help traders of all different levels of skill, time frame, and traders that trade Forex, commodities, indices, stocks, etc. At the core of it is automation, simplicity, and bringing it all into a one-stop shop for you to scan markets more efficiently and build a curated watch list of potential trade ideas. So regardless of what you trade, we hope that our website helps you in some way. And if you have any questions, feel free to contact us using the contact button in the top right or the live chat feature available on our website. We also offer free courses on fundamental and technical analysis on our website, as well as a range of free tools like, for example, our risk calculators that can help traders to level up their trading without paying a dime. Our goal is that our tools and site help you in some small way, and we wish you the very best in your trading journey. Thanks for listening.